It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And here are three things you need to know this morning. Apple's biggest product launch since 2014, receiving a lukewarm response from investors. The long-awaited Vision Pro headset is the tech giant's so-called spatial computer. That's what they're calling it. It offers users a fully 3D interface and integration with everything you do on your phone, from messaging to FaceTiming to gaming. CEO Tim Cook called it the first Apple product you can see through. Investors decided to look beyond the hype themselves, and it was the $3,499 price tag that did it. That announcement, saved right for the end of the presentation, sent shares lower just hours after hitting an all-time high. The people who used it, though, from the event, they loved it. Dan Halley's one of them. We're going to talk to him in a bit. The SEC is suing Coinbase, alleging the crypto exchange operator evaded regulations by trading unregistered securities. Those shares are plummeting in pre-market trading. It's been under investigation by the regulator since last summer, and yesterday, the SEC took legal action against rival Binance and its CEO, CZ, for what it called multiple securities violations. Berenberg analyst Mark Palmer was quick on the draw. He thought some action against Coin was likely in the aftermath. Turns out he was right. We speak with him this hour. And the market so-called melt-up is taking a slight breather this morning, thanks in part to Apple. It's a reminder to investors just how much the recent rally is predicated on a handful of big-name stocks. Wall Street's top strategists are trying to make sense of it all. Yesterday, Morgan Stanley warned a shock profit dip would derail the S&P from its highs. This after Citi said you shouldn't lose sight of a potential pain trade from AI enthusiasm or a Fed pivot. The latter certainly top of mind for investors ahead of next week's CPI report and rate decision.
Well, Apple has entered the headset chat with their pricey Vision Pro spatial computer. Unveiled at Apple's Worldwide Developer Conference yesterday, the Vision Pro is a standalone device meant to change the way we use apps, media, and games. It's the first new major product announcement since the company announced the Apple Watch back in 2014. Investors wonder if Apple can help bring virtual reality into the mainstream or if this is just another high-priced tech toy. With a steep price tag of $3,499, the Vision Pro is significantly more expensive than other VR headsets on the market today. Here with the latest and greatest, fresh off of a flight from Cupertino, is our very own Dan Halley. Dan, it looks like you're still in the airport right now, so give us the take.
Yeah, I just got off my red eye and I got my coffee trying to recombobulate myself, but I did get to spend some time with the Vision Pro. I keep wanting to call it Reality Pro. Look, I went into this demo skeptical. I've used the the Meta Quest 2. I've used the PlayStation VR, way back the HTC Vive, Microsoft's HoloLens. I walked out slack-jawed. I mean, the technology is beyond what any other company has to offer. What you're seeing is exactly what you see when you put on the headset. You can grab apps by pinching your fingers together. The way you navigate is looking at items on screen. So for instance, when I was navigating, I would look at an app and then pinch my fingers together and select it. And it's not as though I have to stick my hand out awkwardly and reach for something in 3D space like in Minority Report or something like that. The lower cameras, the cameras on the bottom, can see your hands, so you can just have them resting on your lap and be able to tap something by just pinching your fingers together to select it. You can grab windows, move them around freely. I put a window up over someone's head, then look to the left, look back to the right, and that window was there. You can have as many windows as you want open. They haven't even gotten to a limit as to how many they can open. The overall AR experience is completely mind-blowing. You start the system and there's a series of apps on the screen. That's your home screen. You look around, they're going to stay centered, and then you just kind of go from there. You can open up Safari, you can open up photos. This is a kind of panorama that you're looking at that you can view. So if you took panorama photos, it's like you're there in the panorama. There was an AR experience that then turned into VR, where you turn the digital crown on top. It's basically the knob up there, and it immerses you deeper. So I was sitting there at what they said was Mount Hood. Never been there, and I don't know what it is. I'm sorry. And I looked down, and I could see my hands fully rendered. So the big takeaway for me is this just blows Meta away. It blows Microsoft away, HTC away, anybody that's working on headsets. they've got to be kind of slumping over this morning because the issues with display quality, no, it's not like looking at a 65-inch 4K TV. That's seemingly at this point impossible, but it's damn close. I was looking at someone in the room through the headset using the pass-through vision, just like this, and I could see every detail on their face. I did one of those FaceTime calls where you get a persona, where it's basically an AI-generated version of yourself and someone else, and it looked pretty good. It was almost uncanny valley, but it was pretty good. There's so many different things that are impressive with this technology. The issues are the battery life is 2 hours. Besides that, you would have to have it plugged in. And the elephant in the room is, what do you do with it, right? This is an incredible tech demo. Where are the apps?
Yeah, I mean, I have a lot of elephants. I have a lot of questions about it. And we were sort of giggling watching the video of the person sitting with this thing on and sort of like pinching their fingers into the air. Because obviously you look a little silly. I mean, the other thing is, you say the battery life is only 2 hours. Like, I can't imagine anybody's going to want to be in this thing for 2 hours at this point. It does make you feel, it makes a lot of people feel unwell, right, from what I'm reading. Even with the improvements in the technology, it still definitely takes some getting used to. The other elephant in the room is how much the damn thing costs, Dan, right? Like you said, it's a lot better than the other products on the market. It is also a lot more expensive. So that's really what the questions are centered around this morning, whether people are going to pay up for it.
Yeah, and I think, for me, like I said, I went into this skeptical. I haven't used the Meta Quest 3 because it's not out yet, and I haven't used the Quest Pro. But I've used most other headsets, including the Quest 2. And I mean, there's no doubt that Apple's technology is the best around. I mean, if you were to wear one of those and then wear one of these, you would be like, well, why would I do anything else? Because the price, I'm not going to pay $3,500 for, the headset. I'm balking at, the $1,100 for the MacBook Air, right? So $3,500 is, a bridge too far for me, and I think most people. The other thing is the apps. You say, who's going to wear this for 2 hours to run the battery down? There are some use cases, maybe. Productivity would be cool because it can connect to a Bluetooth keyboard. So you'll be able to, actually type and see everything on a huge display. That sounds really interesting and maybe worthwhile to me. But I think the broader problem is, okay, so I have productivity, cool. I have this wild device, give me more apps. And I think, that's where Apple is at this point. They're at least 6 months away, right? It releases early next year. That could be March, that could be January, maybe April if you want to be generous. And I think between now and then, is when they really need to get the developer community in high gear and get that killer app. That was one of the things that we were talking about, in our group messages was, where's that killer app? Where's that thing that says, whoa, I need this? Sure, the demo will knock your socks off. But after that, what do? You don't want a $3,500 paperweight.
Yeah, absolutely. Dan, thanks so much for joining us from the airport, no less. Mid-travel came to give the breakdown here on the VR AR play as we're continuing to monitor exactly how it's being discussed outside of the event here on the day. Dan, thanks so much. And we're staying with the tech space. Shares of Apple, you're seeing them higher pre-market this morning after announcing their widely hyped Pro VR headset. Investors, they are wondering if Apple can bring virtual reality or even augmented reality into the mainstream as general interest in the metaverse has dwindled. Shares of Apple yesterday jumped briefly before losing the day's gains by market close. The stock has had a gangbuster type of year so far. Only a handful of tech stocks have driven the S&P 500's gains to date. And Jim Tierney, AllianceBernstein's CIO of Concentrated U.S. Growth, joins us now IRL, not in virtual reality, to give us the deeper dive into the new age of VR and a headset like this. I mean, you think about what we were just mentioning a moment ago, the handful of companies that have driven the gains this year within the S&P 500. And for Apple, seeing a new all-time high yesterday, touching that $3 trillion club almost, and then now making even more product announcements that signal what that next leg of growth could look like. I mean, if you're to summarize what we've seen in tech so far this year, what would that be?
Let me go to a point that Dan made that I thought was very interesting, which is it blows away the competition.
Sure.
And I think for years, every tech company had its own lane and sort of stayed in its lane. And now the space is getting a lot more competitive. Everybody is up against each other. So I'm not sure that those free lanes or the white space exist, yet the market's treating it as every company is going to have sort of unlimited run here. So I think that's an interesting point out of all this. But what we've seen year to date is the tech companies, all of them have done incredibly well. The entire market's gain this year is driven by 8 big tech companies, and most of it's multiple expansion. When you look at NVIDIA, when you look at Meta, yes, they've had really nice earnings revisions. Most of the companies have had downward earnings revisions year to date. So investors are just paying a heck of a lot more for a few select companies, and that's normally not healthy in the marketplace.
And I know that you look at concentrated U.S. growth, which would seem to be maybe some overlap with some of what we're talking about, right? But what kind of concentration do you as an investor want right now in that growth area?
Sure, we run 20 stock portfolios, and our idea is to have a stock or a company against each theme, not 2, 3, 4 in the same. And what we've seen with those 8 big tech companies, they're all rallying on AI. So that kind of concentration, and you see it whether it's the S&P or the Russell 1000, those big companies are about 24% of the S&P, 40% of the Russell 1000. To me, that's worrisome concentration. When I look at our portfolio, we're diversified. We own Microsoft, we own Amazon, but not the others. And that's hurt us this year, quite frankly.
So for investors then that have looked at every single announcement around AI and said, yeah, that's got to be a multiplier effect for this company, by when should they be kind of benchmarking against how that's actually turning into revenue and profit margins for these companies?
It's a great question, and I don't know if many companies have a business model around AI yet. First of all, I know Microsoft does, and NVIDIA is selling the chips for it, but how are other companies going to use that? And then I think the bigger question is, are only 8 or 10 companies going to benefit from this, or will every company benefit? And the market so far hasn't given any credit to the other 490 companies in the S&P in terms of productivity savings. If this is as big as everybody believes it is, there are going to be huge productivity improvements, and whether that's getting more done with fewer people or just doing more with the same number of people, that should drive margins and that should drive earnings for the broader market, but the broader market's getting zero credit for that today.
Right. Well, they're not doing it today yet, right? And even if the market's a discounting mechanism, it doesn't seem like it's happening for a while. Stick around because I want to broaden this out a little bit, but talk more about this issue of narrow leadership. The market, the melt-up, as it's being called, has taken a slight breather this morning. That's thanks in part to Apple. This is the subject of the morning brief today, which apparently I'm saying in my cartoon here. The FOMO crowd may come out of the woodwork to chase the rally. There are an abundance of opinions on how long it will last. And, you know, as I said, we should be watching which stocks are participating here because the bulk of gains this year have been thanks to a handful of large cap tech stocks. Jim Tierney is still with us, AVCIO of Concentrated U.S. Growth. You know, in the melt up, I've been doing this a long time and I've heard the words melt up before, but like it's one of those things that people throw around. I guess it just means stocks keep going up. They're climbing the wall of worry. They're doing whatever they do. And then eventually some of the bears throw in the towel and start buying as well. But I was looking at the S&P versus the S&P equal weight, right, as sort of a proxy for this and the ratio of the two. And as you say, this year it has been the S&P 500 vastly outperforming the equal weight index. But why is that still a problem?
When you're counting on just a few stocks to drive performance, that historically has not ended well. You look at the most concentrated markets, this year so far, year to date, tops it at more than 100% of the performance is coming from just a handful of companies. But in the past where we've seen that, in the 70s and the 80s percentile driving the market performance, it was 2007. It was 1999. It was 2020 and 2021. We all know how each of those ended. So the market has to broaden out, or at some point these 8 or 10 stocks just run out of gas.
Does a melt-up mean detachment from fundamentals?
I think we've had a little bit of a detachment this year. As I mentioned, the earnings have not kept pace. It's mainly been PE multiple expansion. As I look forward, we need a heck of a lot more earnings growth in 24 and 25, and we need more companies sort of driving those gains.
And we saw a little taste of that last week, actually. On Thursday and Friday, we saw a little bit of a broadening in that sort of last push up towards the 20% rally from the lows, but then we sort of failed to get there. Are you seeing any encouraging signs that we're going to get a continuation of the rally accompanied by that broadening?
I think at some point the market has to connect to the economic reality. And it's uncertain what the economy is going to look like in the second half. Sure feels like there are a lot of pressures. We see all kinds of data points day after day, whether it's Fastenal reporting sales this morning that were a little bit disappointing, whether it was Costco a little bit disappointing last week. And remember, we have student loan debt repayment starting again September 1. And that's another headwind to the consumer. So I think as we look forward, the economy is going to be a little bit tougher. So what you're looking for are companies that can sort of plow through that can drive earnings growth in the second half of this year and into 2024.
Does that mean retail can't, because we had seen some of the calls specifically to which we're mentioning around student loans, how that might impact a company like Target. Does that mean that retail is not necessarily part of even the melt-up environment that we've been tracking? Or is there still an opportunity for retail to experience perhaps the overflow?
I think the retail space has been tough because people have stopped buying goods and they've gone more to services. I don't see what switches that back. And you look at where our purchases versus pre-COVID levels, we're still pretty elevated. So I think there's more unwind that has to happen there. So I think retail is going to be under pressure. Obviously, there's a good company here, a good company there. Walmart, as an example, is taking a ton of share as consumers are trading down and buying the basics, sort of at the expense of a Target, as you mentioned.
When you hear the likes of Morgan Stanley say profits this year are going to fall by 16%, does that sound right to you? Is it going to be that kind of magnitude?
Boy, you look at all the margin pressure and you say that's possible, but first quarter earnings were really good. And we didn't have the negative downward revisions. Instead, we kind of had the first quarter gains and then numbers stayed flattish. So we'd have to see a big downturn. Corporate America is incredibly resilient in terms of managing costs, managing margins. And I think what the tech companies did, and part of the reason we got such a good bid for the tech companies, is they cut costs aggressively. And if we see more of that spread throughout corporate America and those earnings hang in, I think that could be a nice surprise in the second half of this year.
All right, stay with us, Jim. We've got much more to discuss here this morning. We do have to pivot, though, and talk about Coinbase. Coinbase is the latest crypto exchange in the SEC's crosshairs. The regulator is suing the crypto exchange, alleging that Coinbase was acting as an unregistered broker and exchange. And joining us now is Yahoo Finance's Jennifer Schonberger with more on this. Jennifer?
Good morning, Brad. That's right. The SEC suing Coinbase this morning in the Southern District of New York for failing to register its trading platform with the agency, alleging that it was an unregistered national securities exchange, broker, and clearing agency. The SEC also bringing charges against the largest U.S. crypto trading platform for failing to register its crypto asset staking as a service program. According to the SEC's complaint, since 2019, Coinbase has made billions of dollars unlawfully facilitating the buying and selling of crypto asset securities. SEC Chair Gary Gensler saying in a statement this morning, quote, "We allege that Coinbase, despite being subject to securities laws, commingled and unlawfully offered exchange, broker-dealer, and clearinghouse functions. In other parts of our securities markets, these functions are separate." The SEC alleges that since 2019, Coinbase has been engaging in an unregistered securities offering through its staking as a service program, which essentially allows customers to earn profits from the proof of stake mechanisms of blockchains, as well as through Coinbase's efforts. Through this staking program, Coinbase allegedly pools each type of customer's stakeable crypto assets, stakes the pool to perform blockchain transaction validation services, and provides a portion of the rewards generated from this work to its customers whose assets were part of the pool. Now, the SEC says Coinbase failed to register its offer and sales of this staking program, which would be required by law. I have reached out to Coinbase for comment. A comment was not immediately available. However, I did speak with Coinbase's Chief Public Policy Officer, Faryar Shirzad, earlier this spring about whether Coinbase has tried to register with the SEC. He told me that they have filed questions to the SEC going back a year ago to last June. Take a listen to what he told me.
There's no path to registering We've tried, and there's just no way to do it. And in fact, we've submitted a petition with the SEC back in June where we enumerated the specific issues that the agency would have to resolve for crypto platforms to be able to come in and register. We think the opportunity to build a crypto securities market in the United States is enormously exciting, but we've stayed away from it because there's no path to registration and there's just no way to do it.
These charges coming just a day after the SEC leveled charges against Binance, Coinbase's rival, as well as Binance's founder, CZ, for operating an illegal trading platform and misuse of customer funds. Guys?
Jennifer Schonberger, thank you so much for covering this for us. And this is so interesting, Brad, because it has set up the crypto industry, which has portrayed itself as victimized by regulators who have not offered it clear guidance. You heard that also in the comments that Jen cited there, versus a regulatory regime that's saying you're not supposed to be doing this. It's quite an interesting tension.
Right, and it seems that each of the people that were at the top of some of the offerings or the decisions to bring these offerings to market, they knew that they were offering this to customers in the US where it was unregulated and they were not registering the exact type of service they were bringing to the table. And for those who don't know, staking is essentially where people can purchase a cryptocurrency, store those coins from utilization for a period of time, and store them with Coinbase in that capacity, and then use those as part of transaction validations, which typically help for blockchain viability there. However, if those coins are being put to use elsewhere, then it raises a larger question of, all right, similar to what we have seen in other crypto practices, where there is a misuse or mishandling of coins that were supposed to be meant for storage, and instead being put to use elsewhere as well.
I mean, if I understand it correctly, it's kind of like what banks do in their business, right?
Yes.
You put your deposits at the bank, right? And the bank can effectively
use that to lend.
Correct. But you're not supposed to be doing that with cryptocurrencies. I mean, I should mention we're showing Bitcoin up on the screen here because there is this broader now sentiment hit to cryptocurrencies more broadly as a result of these regulatory actions, because there are a lot of questions about what it now means to hold crypto, particularly in the US, where you can hold it, what you can do with it.
Right.
And so we've been seeing Bitcoin move down. Binance's coin is actually not moving much today, but it has been moving down. I mean, it's more meant. Isn't Binance more of a stable? I don't know that much about the Binance coin.
Binance USD was more of the stable coin
so it's not
play
been
there.
moving much.
But they had offered for Binance, for Coinbase, they had just started their staking practice, or at least the service, within recent years and since going public. And they had kind of two drivers from that. There was a price from impact, but also the staking rewards rates as well that they had to communicate continuously. And so even within the end users looking at it as a reward type of process, that's how they were leveraging it within their marketing to get more staking to take place. And it was a small portion of the revenue they were bringing in.
Well, coming up later, we're going to talk to Mark Palmer of Berenberg. He says that this kind of action could affect 37% of Coinbase's revenue. So we're going to get more details from him. Taking a step back to the macro, while the long talked about recession has yet to hit in the U.S., investors are still facing conflicting trends. So let's talk about some defensive plays, perhaps. Back with us, Jim Tierney, AllianceBernstein Concentrated U.S. Growth CIO. Jim, you sort of mentioned this before, right? That in this environment, you want to find places that are going to be sort of more reliable, if you will. So where are some of those areas? I
love healthcare right now. If you look at hospital admission trends a couple years ago, people were afraid. They were pushing off elective surgeries. We were seeing trends down 3 to 5%. Last year, they were flat. This year, based off of first quarter numbers, they're up 3 to 5%. So a company like an Abbott, as an example, which is providing a number of products on the elective side and some non-elective, that's an interesting opportunity, one that I own, one that my clients own. Anything volumetrically related, I think, is going to do pretty well here.
I mean, Abbott's had some challenges, though, right? Related to formula, related to some. So does that mean that it's attractive from a valuation perspective as well because of some of those struggles?
I think it's very attractive. First of all, they have more than $10 billion of cash that they're going to be able to use at some point, whether that's share repurchase or doing accretive M&A. Secondly, when you look at the formula market, there are long-term contracts. And I know the government's looking into that, but there's real stability there. So I think that this is a much more stable, growthier kind of healthcare name that's pretty darn attractive right here.
There's been a ton of focus around financials this year, and for perhaps the wrong reasons because of the banking turmoil that ensued mid-March. You think about any type of rebound play that could be in sight for financials. Is that clear on the horizon, or is there still more to be concerned about within that sector specifically as we're looking across the landscape here?
Sure, we own Schwab and I own it as well. I think that's a real opportunity. You have the TD Ameritrade cost cuts. They did another wave of client cutovers this past weekend. Or Memorial Day weekend, you're going to be able to pull out a lot of cost out of that model in 2024. They are the low-cost provider. They're seeing assets come in the door day after day after day. Now, I understand people are worried about cash sorting, but what we're seeing is sorting behavior is really starting to tail off. If the Fed's on pause, or if we even get a rate cut late in the year, that kind of is the final nail in the sorting coffin, and I think that would be very well received within financial investors and those stocks.
I'm really sensing a theme here, at least in these two examples, right, between Abbott and Schwab, because there's definitely been headline risk with these two stocks, but you're jumping in. Are there any other examples of companies like that you're looking at?
Oh, I love names that have no controversy, and certainly Microsoft falls into that category, right. and a nice AI play, as well as the cloud business sort of bottoming here, and that's wonderful. So I'm not looking for controversy.
It was just coincidence, those two that we talked about. Jim, thanks so much for coming in today. It was good to spend some time with you. Appreciate it.
Thank you.
Jim Tierney is AllianceBernstein Concentrated U.S. Growth CIO. Well, coming up, a look at some of the market moves on the heels of Apple's Vision Pro announcement. As always, you got to look at that Apple ecosystem. What this product launch could mean for the company's partners is next. Welcome back. We're coming up on the opening bell on Wall Street here. There you have it. Looks like HP I wonder if that's Helmerich and Payne or HP, the computer company, ringing the opening bell. I suspect it's the former. In any case, let's take a look at the opening numbers here as we get underway this morning. Yesterday, the S&P 500 came within a hair's breadth of coming back 20% from the lows of October. It looks like it's not going to make it there today either. The S&P right now is off by about 0.1%. The Dow and the NASDAQ are trading lower as well as we get underway here this morning. Brad Smith never wants to hear the words hair's breadth ever again. Okay, I'll stop. I'm sorry.
Major averages today are feeling a hair's breadth of red as we are red across the board. The Dow right now, that's down flat to the downside by about 0.1%. Let's give you a chart here just to line things up for the course of the past 2 days here. Yes, taking a look at the Dow Jones Industrial Average, you're seeing that down by about 0.7% over the past 2 days, but flat just barely to the downside here today. We'll see if that can get back in positive territory. The NASDAQ Composite, you're seeing that lower by about 0.25% right now for the tech-heavy average. We'll keep a close eye on this. Was positive for the majority of yesterday. You got to imagine much of that around the time, of course, where Apple was continuing to roll out some of their announcements at WWDC. However, trailed off towards the end of the day. Right now, down by about 0.3% for the tech-heavy average. And the S&P 500, that's down by about 0.2% over the past 2 days, down by about 0.4% though there. Taking a look at the 11 S&P 500 sectors, we are mixed right now. Utilities actually leading the pack here out the gate this morning. We're 0.5% higher for the utility sector. Meanwhile, bringing up the caboose, you've got energy. That's down by about 1% early in trade this morning. Technology also seeing a little bit of a fade activity there. That's down by about 0.4%. Let's take a look at some of those tech names since we were mentioning and bringing them into the chat a second ago. Apple, zeroing in on that after its WWDC announcements day. Right now, down 0.5%. So we're moving further away from that $3 trillion mark, but we'll see if we can get back towards it later on this week. Microsoft, Alphabet as well. They're also in negative territory. Just to give you an overall view of the heat map, a lot more red than green. However, it still seems like there's a decent balance as of right now.
Yeah, interesting. Fastenal, which Jim Turney just mentioned here, is out with earnings this morning, and those shares are down by 3.7%. So we're talking about industrials and suppliers, that falling into that category. Although, not bad for the year to date. Not like a tech company, but still not bad. Speaking of tech companies, though, let's get back to Apple and the Apple ecosystem. Its new product announcements are sending shares for some of its suppliers like Taiwan Semiconductor and Unity Software in different directions today. The reveal of Apple's long-awaited mixed reality headset initially got investors excited about what the platform could mean for the partners. Now, let's take these one by one because they are really quite different stories. Unity Software yesterday got a huge boost, and it's still one of the top trending tickers on the Yahoo Finance platform. Why? Well, basically, it's going to be a partner on the Vision Pro. And so that is good news, seen as good news, and seeing some analyst commentary around this. Morgan Stanley says that Unity is going to play an important role in creating new content for the Vision Pro. It's expected to create some apps for the new device. So that's why you saw that big boost to the shares yesterday. Yeah, huge opportunity here for Unity to continue to get this partnership right over the past 3 months, looking pretty good, up by about 20% in year to date, having a standout year as well. And this comes off of what they had already seen in their first quarter. A strong start in 2023 is what they framed it as, with their revenue there up 56% year over year. And then additionally giving some guidance, exceeding the revenue guidance that they had provided during their previous earnings as well. And so you got to imagine for Apple being one of their huge, not just potential customer success stories, but where they could net out some other major business as a result of that type of visibility through a partnership with a company like Apple as well. Yeah, definitely. And then Taiwan Semi, we don't know for sure, but the implication yesterday was that Taiwan Semi is one of the main suppliers for Apple's new device. But on the flip side, Taiwan Semi is also coming out and making its own news today. In its investor day, the chairman of the company said this year's spending will come in near the low end of its projections at about $32 billion. Now, $32 billion is still a lot, but it's still something that people in the semi industry are paying attention to. The shares actually did not go up yesterday on the Apple announcement. They went down a little bit, and they are going down further if you look at them today here. So global smartphone shipments are also going to drop this year, according to TSM's CEO, although he says that its market share will grow. I mean, TSM is just so dominant in this space, but still, it's something to continue to really zero in on.
I mean, it's the company that really prompted the rest of the world to figure out how it can get its fabrication processes brought online. And for the designing of chips, that's one thing, but the entire manufacturing and the fabrication of that is a totally different set of operations that Taiwan had largely been able to dominate. And so now you're seeing a wave of investments, whether that's triggered by being able to have more investments from state or nation-run entities into pushing more of those dollars towards some of the companies that are going to be able to fast-track bringing that capacity online. One of them, a company that we're about to talk about in a second here. But at the same time, it's just a question of for how much longer will TSM be able to kind of box out the competition, as it seems like there is a lot of production and capacity that's going to be coming online very quickly over these next 18 months or so.
Yeah, and obviously there's some geopolitical risk associated with them too, which they were asked about at that investor day. Let's talk about another chip maker though that you alluded to. That's Intel. It's taken a couple of hits today. Initially it dropped yesterday about 4.5% after Apple announced its latest PCs with its own M2 chip. And also a regulatory filing on Monday showed Intel is offering 35 million shares or about $1.5 billion stake in its self-driving tech unit Mobileye. Now we knew that it was going to be working down some of its stake in Mobileye, right? But Mobileye is the unit that it bought and then spun off late last year. $21 a share is where it spun it off. And the shares have done well since then, but they're falling today. Yeah, and it also kind of gives a nod to the amount of competition that is continuing to come about, especially in the assisted driving market as well. You've got other chip makers that are excelling within their own partnerships. NVIDIA has absolutely been kind of crushing the mind share game right now, and everything from AI all the way into gaming GPUs, and then even furthermore, still maintaining some of their, of course, dominance where they can in the assisted driving market. And then Qualcomm as well, going to be an interesting one to track within that space too, seeing some development in their own partnerships that they're able to net out. So a larger question of what Intel might be sensing in the water that leads them to perhaps at least convert or see some liquidity in that share, in the amount of shares that they had held on to in Mobileye still. Yeah. Also, let's talk about GitLab. I've been tracking this one this morning. It's interesting. Soaring today after using the magic word AI in its first quarter results. The CEO said that saying in the report that GitLab is positioned as the AI-powered leader in its field. This coupled with an earnings beat that has investors very excited here. Full quote there. They said, with AI revolutionizing how companies develop, secure, operate software, they believe that GitLab is positioned as the leading AI-powered DevSecOps platform. Now, Dev, you want to translate that for us? Yeah, I'm going to try to my best because I was more on the cloud solutions side in my previous job. But developer security operations is what I remember that to be. I hope it's still correct. Yeah, basically, I guess it's a software package that can develop and operate software. Yeah. As always, when you see a jump like this, my brain goes straight to the short interest. About 12% of the float is shorted, so you might be seeing some kind of short squeeze effect here because it's not crazy high, but it's not that low either. So that might be exacerbating some of the move we otherwise might see. But yes, legitimately, there's enthusiasm here. It looks like with that top line beat in particular. Yeah, and the organic revenue growth as well that they called out, about 45%, perhaps investors giving a little bit of a nod to what that could potentially lock in terms of some of their future growth as well here. Yes. Also, we got to talk about the SEC. The SEC suing Coinbase, alleging the crypto exchange operator evaded regulations by trading unregistered securities. Shares are plummeting. It's been under investigation by the regulator since last summer. Yesterday, the SEC took legal action against rival Binance and its CEO, CZ, for what it called multiple securities violations. Berenberg analyst Mark Palmer thought some action against Coin was likely in the aftermath. And guess what? Mark joins us now. So, Mark, great to have you here on set with us. Good to be here. I mean, you saw this coming, essentially, as the rest of us were probably sensing was in the cards here for the SEC.
The SEC telegraphed this action. We had seen prior actions brought against crypto exchanges, Bittrex, BXC, Kraken, and now Binance, each of which included elements that were consistent with the Wells notice that the SEC presented to Coinbase back on March 22nd. So in our view, nobody should have been surprised that this occurred. and even the elements of the case lined up with what we expected. The one thing that was a bit of a twist is the fact that the SEC focused on 13 tokens in particular that it identified as securities that Coinbase trades. Big names in there: Solana, Cardano, Polygon, as well as 10 others that are a bit less well known. But the upshot here is that the dragnet that the SEC has put out against crypto continues, and we don't think it's going to stop anytime soon.
So Coinbase obviously had been in discussions with the SEC about all of this, has complained about the lack of clarity. Mm-hmm. But I have to wonder if it, I mean, presumably the company also knew that this was coming. Why didn't it stop doing what the SEC didn't want it to do?
Well, frankly, I don't think it would be able to, given the portion of its revenue that is represented by these actions. If you look at the unregistered, or the trading of unregistered securities, which is what the SEC characterizes the crypto tokens that Coinbase trades, Bitcoin is the one big exception there that the SEC sees as commodity and not a security.
And how much of trading on Coinbase is Bitcoin?
Bitcoin is a significant portion. It's about a third of its trading in terms of volume, but it makes very little money on that Bitcoin trading. If you look at alternatives, they offer Bitcoin trading fee-free. And so Bitcoin is effectively a way to bring consumers onto the platform. It's not a way that the company makes money. If you look at staking, that represents about 10% of the company's revenue. That's targeted in the lawsuit. So you put all of that together, what we estimated was that if you looked at all the unregistered securities, i.e. the tokens that Coinbase trades, other than Bitcoin, add to that staking, it was about 37% of the company's first quarter net revenue.
And so in simple terms too, because I was trying to, as we were reading through the SEC allegations here in the suit, I was trying to the best of my ability to figure out what they did wrong within their staking practice as well. Is it clear, is it evident what they were doing in terms of the number of clients that they had marketed staking to, seen revenue come in from, and then what essentially were they doing with those coins that they were staking?
Well, really it was just the fact that Coinbase was involved in staking in general without registering a staking platform with the SEC.
Got it.
In the eyes of the SEC, staking, the action through which proof of stake tokens are created is in itself a means through which securities are created and exchanged. There's really no way around that. Kraken already settled with the SEC, basically put its U.S. staking operation to rest, continues to operate overseas, and that really is one of the big questions now with regard to Coinbase is, will it be able to pivot overseas the way that it has begun to do, beginning with the launch of a derivatives exchange in Bermuda, and it's also looking at Dubai, Singapore, other geographies where it could set up shop. But in the first quarter, the U.S. represented about 86% of Coinbase's net revenue. That is not an easy pivot to execute.
Well, and you have I think a hold recommendation on the stock.
That's correct.
So it's from that I'm implying that you think the jury's out on whether to be able to pivot, or what is the probability that they're going to make it through this even as a viable business?
It's, first of all, there is going to be a pushback from Coinbase in the courts. And that is on multiple fronts. In fact, we believed it was possible that the SEC would hold off on bringing this action against Coinbase until there was a resolution of Coinbase's request for a writ of mandamus that would compel the SEC to bring rulemaking on cryptocurrencies. Mm-hmm. That case is still pending in the Third Circuit. But I think the confidence the SEC has that it will win was demonstrated in the fact that they just pushed forward and filed an enforcement action against Coinbase. Beyond that, there's the possibility that portions of the business beyond what we have identified could continue to operate. But there are other portions that could be at risk. For example, the company generated about 27% of its net revenue in the first quarter from interest earned on USDC, the stablecoins. Mm-hmm. Now, if you go back and look at the Federal Reserve's rejection of Custodia Bank's request to become part of the Federal Reserve Network back in January, there was a lot of language in there that was very specific about their concerns about stablecoins and the potential for their use to facilitate illegal activity. Frankly, I think that same argument could be applied to USDC, and we would not be surprised if USDC came within the SEC's focus. Again, that was 27% of the company's revenue on top of the 37% of the company's revenue in the first quarter that we viewed as at risk. At some point, that's effectively 2/3 of the company's revenue that we're talking about. At some point, you have to ask, where are they going to be able to make this up?
You mentioned Kraken and the settlements that they went forward with the SEC. Yeah. That won about $30 million just for staking alone. So now if we were to add any type of proportion to this for Coinbase or even for Binance, what does that look like as investors are trying to wrap their heads around how much the company might actually have to pony up just to settle with the SEC or in fines with the SEC in the future?
Well, again, if you look at the Kraken situation, I think that number is one that is the result of a settlement where they talk about what's big enough to make the SEC look like they took their pound of flesh, but at the same time, not something that's going to put the company out of business. I think in this case, this is more existential. Coinbase has basically said straightforward, they cannot operate their business in the US if they have to register it with the SEC. Hence, there's not a lot of middle ground there.
Interesting.
Well, and isn't there then also the idea that if I'm a US-based investor with my assets at Coinbase, I already saw one sort of retail investor tweet this morning, like, take your money out. So how big a risk is that you see now flight of customers from the platform when they see these headlines?
I think based on what we saw happen in 2022, when so many different crypto platforms effectively trapped the assets of their customers on their platforms, it's almost inevitable that you're going to see at least some reaction among consumers. And that's prudent on their part. The reality is that right now, the only crypto token that is beyond the purview of the SEC or that the SEC has effectively blessed is Bitcoin. So if you look at Bitcoin-focused operations, Lightning Network, which is the layer 2 built upon the Bitcoin blockchain, those operations, I think, are going to be able to operate and may flourish in the US simply because all of the other crypto operations are going to find it difficult to do so.
So the industry has sort of painted this as the SEC is at war with crypto. Is that accurate? And what are the implications for not just Coinbase, not just Kraken and the others you mentioned, but really the whole US crypto industry?
Right. I think the way that you can characterize this is that the SEC is trying to bring crypto under the umbrella of its compliance and wants to see all tokens that it views as securities, and that's a big question, which tokens are securities, which are commodities, wants to see all of those tokens ultimately trade as registered securities on platforms. Bitcoin, again, because of its decentralized nature, is an exception to that. So yes, Bitcoin will continue to exist in the US, to be traded in the US. We actually expect that one of the things that could occur as a result of what we're seeing is that the Bitcoin blockchain as an application layer could begin to thrive. We're already seeing this recently with what are known as Bitcoin ordinal NFTs. The Bitcoin blockchain suddenly in the last few months jumped up to be the number 2 blockchain in terms of sales of NFTs.
What's the number 1 right now?
It's still Ethereum.
Okay. All right.
And Ethereum is the monster. Frankly, one of the things that we were looking for in this case to get a sense of what the SEC is thinking is, would Ethereum be, or Ether, the token of the Ethereum blockchain, be seen as a security as well? It was not mentioned as one of the 13 in the case.
And just very quickly, before we let you go, you talking about what sounds like almost Bitcoin maximalism reminded me to ask about MicroStrategy. Speaking of the Bitcoin maximalist of all maximalists, Michael Saylor, who's the chairman of the company, what does all of this mean for it and its big Bitcoin stake?
We are bullish on MicroStrategy for all of these reasons. The fact that we do believe that this could be Bitcoin's moment in the sun, so to speak, and that MicroStrategy holding 142,500 Bitcoin on its balance sheet is well positioned to benefit from that, especially because there is a catalyst here, which in May 2024, we are expecting to see what's known as the Bitcoin halving. Which is when the Bitcoin miner rewards are cut in half. It has an effect on the supply of Bitcoin. Hence, it has an effect on the price historically. There have been 3 halvings so far, and with each one, there was a run-up in the price of Bitcoin 6 months before that event and 6 months after. Again, the next halving is in May 2024, so we view that as an important catalyst for MicroStrategy, and we think that amidst all of the chaos in crypto, Bitcoin represents a safe haven. MicroStrategy represents a way to play that.
Mark Palmer, Berenberg Capital Markets, Senior Equity Research Analyst. Mark, great to have you in studio with us today. All right, guys, and coming up, analysts, they are weighing in on Apple's latest product launch, what the company's VR foray could mean for investors. That's coming up.
We got a couple of big announcements here from the tech giant, and among them was this long-awaited headset that we're looking at right now.
We heard Tim Cook say specifically it's the first Apple product you can look through and not at. And we do have a price tag, $34.99. We're talking about $3,500, and that's going to be the real test for Apple. How many people are, willing to shell out that kind of money?
I think a lot of people are going to balk at that price. Apple recognizes that this is going to be a low-selling product for the time being, and then eventually they'll likely lower the cost of that. But as far as VR, AR goes overall, this seems to be the one that's going to get people the most interested.
I think they did a good job of positioning it in a way that a lot of different people could see, oh, maybe I could use that. That is, of course, until the price point hit, and then that's obviously a big concern. The question really for me is, what's the long-term wearability of the device? But that'll be a big question, is what's the long-term comfort, and then does it deliver enough value for that $3,500 price point?
$3,500 is a tough pill to swallow for anybody. It creates a difficult go-to-market, I think, but Apple is very good at delivering unique content in a very seamless way.
There was a bit of a decline coming into the opening remarks here, and then we really saw a big sell-off. That big down red candle, that came off on the announcement of the headset. Is that ominous? I think it's a little bit too early to tell you, but I think it's notable, too, that Apple had climbed to a record high just before that announcement.
The hyped Vision Pro announcement briefly boosted shares of Apple yesterday, but in the long term, investing in product launches isn't always an exact science. Joining us now from the floor of the New York Stock Exchange with his perspective and to break it all down, the man with vision himself, Jared Blikre.
Oh, I can see so far. Let me go to the Wi-Fi Interactive. I'm gonna chart this. Apple has been a tricky beast to trade, frustrating both the bulls and the bears at various times over the last 2 years. This is how long this candlestick chart goes back. And I just want to point something out. First, we are just barely exceeding, and by the way, that was a record high yesterday, yes, but barely breaching the high that we saw, and that was a record high in December of 2021. We came all the way down and took out this June low in December and then raced higher. So anybody shorting that breakdown right there got a maximum pain trade. And then I'll say another thing. The angle here of attack is impressive that Apple has been able to keep this up for so long, but these steep angles usually break. It doesn't mean that we won't see higher highs in the coming weeks and months. It just means that Apple is probably due for a respite or a little bit of a pullback. As I mentioned yesterday afternoon after the announcements were done, I find it very encouraging that Apple has been able to maintain its dominance and relevance among all the AI hype when it's not getting the headlines there. And of course, there's a ton of AI behind every single product in Apple and everything that it does, but it's not getting those Microsoft Bard and ChatGPT headlines that Microsoft is. So enough about Apple for now. I want to get quickly to the bond market. We're seeing things quiet down nicely for all the consternation about the debt market, about the debt ceiling rather. Looks like things have rather calmed down. Here is the ICE B of A move index that I'm looking at, the Wi-Fi Interactive. This is a year-to-date chart, and you can see this series of down red candles that I've highlighted on the right. We now have the move index, and that's like the VIX of the bond market, back down to lower levels that we haven't seen since the earlier part of the year, which was before all the banking trouble, the regional banking trouble that we had this year, guys.
Thanks a lot, Jared. Appreciate it. We'll keep watching not just Apple, but all that other stuff too. Let's talk about analysts' reaction to Apple's widely hyped but pricey Vision Pro headset. Morgan Stanley's Eric Woodring calling the device a, quote, show me story, needing killer apps to truly drive success. Others, like JP Morgan's Samik Chatterjee, calling the Vision Pro a potential catalyst for the VR market, although its hefty $3,500 price tag may keep consumers at bay. And Wedbush's Dan Ives sees the headset as a developer moat for Apple, forecasting a surge in apps and growing use cases in the coming years. Ives has maintained his outperform rating on Apple, holding steady at a $205 price target. And guess what? Dan Ives, from the screen to the flesh. He's here with us in the studio. Didn't need any AR, VR for that, Dan. I'm going to ask you the question that Dan Howley talked about earlier, which is, what is it for? Like, what do you use this thing for? And I think that's really, especially given the price, the question that people are asking.
No doubt. And remember, this first iteration, it's not consumers. It's essentially aimed at developers, because there's a battle right now for developers in what we see in tech, from Microsoft to Google, obviously to Apple. Look, I believe the use cases, the applications, it's going to be in the thousands in terms of how consumers could use this down the road. Gaming, health, fitness. And I think this is the start of what I view, I almost call it an iPhone moment in terms of where this is heading over the next 5 to 7 years. And I think for Cupertino to bring this out now, it's the grand entrance.
Where does the price have to come down to over the next 5 years, if that's kind of the timeline that we're looking out to? Because near term, this environment, we're already looking at consumers not just trading down, but they're fading some of their tech purchases.
1,500 in the next 2 years. That's sort of the price point where I see this ultimately going. But that's the DNA. That's the playbook of Cupertino. They're going to come out, expensive product, developers, use cases increase, investors skeptical like they always are, and then ultimately 2-3 years down the road, you'll get prices that are halved with the applications and use cases that are in the thousands. And that's how Apple right now is again on the verge of a $3 trillion market cap. They're playing chess, others are playing checkers.
It doesn't sound like then that it's going to be a real revenue contributor for a long time.
Yeah, in the near term, this is bread at the restaurant, an appetizer. In other words, like this, from a revenue perspective, and you saw the knee-jerk reaction yesterday, but I think right now, this is laying out a longer-term strategy. I think some of the parts, when you think about what they're doing here, this is really the start of an AI ecosystem in the App Store that they're going to be building. And I think on some of the parts, $30 to $40 per share as you look down the road what this could add.
Interesting. And so as we're thinking about the rest of the announcements that Apple had made over the course of yesterday, a lot of software updates, iOS, a lot of the MacBook updates, which much of that expected. But what does this also mean for some of the other tertiary players that are looking at Apple, that are looking to drum up partnerships and make sure that they're part of either the development of hardware or even on the software experience?
Well, because for Apple, you want to be part of the ecosystem. And you look at like with Disney, obviously, partnering, you look at Unity, obviously, on the gaming side. And I think this is really the start of what's a revolution that's happening in tech. Developers are trying to pick their spot. Microsoft, Google, Apple. And that's why yesterday, Cook's talking not to me and you. He's talking to developers. Right. And that's right, because there's a Game of Thrones, a street battle for developers right now in tech.
Yeah. Your colleague, Laura Martin over at Needham, thinks Apple should buy Disney as a part of this whole growth push. What do you think?
Look, I think, and Laura, someone I respect a ton, I think it's one on paper, it's always made sense. But realistically, Apple just doesn't do M&A. I mean, Beat's biggest acquisition, they've done $3.4 billion. And I think that time is come and gone. I think there was a time Netflix, we've talked about, where they could have bought them. But I think right now, this is actually flexed the muscles. Apple right now is in more of a position of strength today than they were 2-3 years ago. And that's despite, obviously, a lot of bears coming out of the caves trying to, think negative was going to happen to Apple, and now we're sitting here again on $3 trillion market cap verge.
Getting there. 190, I think, is the per share number that we're talking about. I want to pivot for a moment because you cover a lot of different stocks that we track very closely. C3.ai, Ben Axler of Spruce Point Capital was on our air yesterday. He's got a short case against the company. He was talking about it. And that company has been one of the most hyped AI companies, obviously. My understanding is that it's been around for a few years. Software pioneer Tom Siebel is the guy who founded it. It doesn't really do generative AI, is my understanding. I mean, it's an AI company. There are a lot of AI companies out there. Is the surge that we've seen in these shares justified?
Look, I mean, we believe, and obviously Spruce done a ton of work as well as a lot of the bears. This is a battle right now in terms of bulls, bears, and can the execution story play out in C3? We believe it can, which is why we upgraded it. And we've been bullish, been bearish, and I think right now in terms of what's happening in AI, I think it's the biggest transformation that we've seen in tech in the last 30 years. And when you look at Siebel, you look at C3, there's a huge opportunity for them. But now, and there's a big spotlight, they obviously have to execute step by step. Because obviously a lot of, negative views out there. And that, I think that ultimately speaks what we're seeing in this environment, right? I mean, every time I have a bullish Tesla note, I get 30, 40 emails I couldn't repeat on air in terms of some of the haters. So it speaks to, it's a divisive time right now between the bulls and a lot of those bears that are now deep in the caves in hibernation mode.
So what is the benchmark timeline for some of the major investments, especially given the thrust of either FOMO or people who just want to look at the AI space and get a snippet of it and get involved? What's the benchmark that they should be looking at? We're trying to get a sense of that from everyone who covers this space.
Sure. I mean, the New York City cab driver knows Microsoft, NVIDIA are obviously top of the mountain. But you look at second, third, fourth derivatives, I think it's just starting today. In other words, now look, going back to some of the I think worries out there, are there going to be fakes? Are there going to be ones where there's hype but not real, no meat on the bones? Yeah. But I think overall, this is going to be a transformational trend across software, cybersecurity, big data. Look at MongoDB. You look at names like Palantir. You look at names like now all of a sudden that are on the radar because they built moats. And now you're starting to see the use cases. And it just comes down to anyone that talked hype wants NVIDIA, and that's going to be known as guidance heard around the world. Yes. When they came out with that, that's where any of the skeptics, the scheme that were skeptical of Tom Brady coming out of 2000 draft out of Michigan, 6th round.
Well, speaking of skepticism, I want to circle back to Tesla for a minute because I get the other side of it, by the way. If I say anything critical of Tesla, I hear from the people who you don't hear from when you write the good notes. Sure. So there's a lot of obviously strong feelings about it on both sides. But the stock has been steadily creeping up here this year. It still has not reattained its highs. but it's seen some recent enthusiasm. And the question I always ask with Tesla is whether it's going to be able to deliver. Clearly, it has in the past, but as time goes on, it then has more and more to deliver on.
Totally. I think essentially, once the shareholder meeting down in Austin, I think where Musk laid out the vision, talked about finally starting to advertise, talked about maybe the view from a battery technology perspective, margins, and I think ultimately planted a flag. In other words, like that's the one where it's like, okay, here's what we need to do for the year, and this ultimately is what we need to execute on. Look, in my opinion, Tesla's a name where, just like my view on Apple or Amazon or Google over years, if you look at over a 1 to 2 quarter period, you miss transformation, what's happened. I think the price cuts were the smart move. They essentially put an iron fence around their install base. Now, this next quarter coming up, we'll get obviously orders, first week in July. In terms of units, you need to deliver in China. And I think that ultimately, the biggest, debate right now from the bears, it's China. Can, in a price war, they ultimately navigate that? That's what Musk and Tesla need to navigate, and we believe they can.
Dan, stick with us for a hot second here. We've got some breaking news that's been coming out.
If you've noticed us looking down at our computers a lot.
Monitoring some headlines a lot. Based on a CNBC report as of right now, the PGA Tour has agreed to merge with the Saudi-funded LIV Golf Tour, LIV. And we talk.
I love watching Dan's reaction in real time. Not that you cover these; these are not stocks, obviously.
But you and I we've been waiting for our Masters invitations for years at this point,
and they still haven't come.
Mine's in the mail. That's what they've been saying. I mean, your immediate reaction after you see a sport that we both follow having a major tie-up after years for the PGA taking so much criticism because of how quickly LIV has been able to take over some of the golfers, get fanfare for a tour that's got now some fans that are just looking for an experience that's more like a concert instead of like the country club.
Yeah, I think, but this is also a shock, right? Relative to obviously the controversy with the LIV Tour and a lot of core PGA professionals in terms of, with their stance, McIlroy being one of them. So I think this is something that we need to see ultimately the reaction, how this plays out. But I'd call this, just as a huge golf fan, an absolute shocker.
Yeah, I mean, what are the golfers going to do? How are they going to react to this, the ones who have been resistant to LIV?
And do you have multiple formats that live in tandem, no pun intended?
And then you have Mickelson, who's probably sitting there with a glass of champagne because ultimately this really was a big part of his sort of view.
Yeah, right now I imagine he's shaking up that champagne and just letting it rock everywhere right now. But yeah, the big news that's kind of been rattling through some of the social media landscape. We'll see if we get any more details around that. Dan, very wide-ranging conversation that it's turned out to be.
Great to be here.
Absolutely.
Thank you.
Dan Ives of Wedbush joining us here on set. We appreciate the time as always. Absolutely. And guys, coming up, why our next guest says the Fed could skip a hike in June, but don't count out July. We'll speak with the Bank of America's Michael Gapen. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith. And as we take a look at markets today, we are not seeing a lot of movement here, right? We've got all three major averages that are very little changed in today's session. So I've been watching on the Yahoo Finance Interactive what is moving. Oil futures are certainly moving here today. We had that bump up yesterday as Saudi Arabia announced a surprise production cut for the next month. But now we've got prices coming back down. There's still some talk about demand here and whether that's going to be robust enough. And the Saudi Arabia cut is indeed just short term. So if you look at how that is then feeding through to the equity markets today, as Brad pointed out earlier, we've got energy stocks in the red, not by much, just down about, call it not even 0.2% here. Consumer staples down the most, and then we've got financials and materials up the most in today's session. We continue to watch the big NASDAQ movers in today's session, but there too, we do not have an enormous amount of movement. Interesting, a day after we see the Apple unveiling its Vision Pro, to see its shares down and Meta shares up a little bit, 1.2%. Meta, of course, offering the much cheaper alternative to the Vision Pro, although as we heard from our Dan Halley, the Apple product is a superior one at first blush. So that's something that we'll continue to watch. And then just quickly want to check crypto stocks as well. Coinbase continuing its downward trajectory after being sued by the SEC, off by 15%.
Well, the S&P 500 is approaching bull market territory, but that doesn't mean everyone is betting on the index to rise higher. Our markets reporter Josh Schaefer is here with an outlook on the S&P 500. So, Josh, what do you got for us?
Yeah, Brad. So what I brought with me here today, we got a fancy chart over here, right? Let's take a look at this chart from Bespoke Investment. And what you're looking at is speculative investment or speculative bets on what the S&P 500 will do in the future, right? This is bets on futures. And investors are largely short on the S&P 500 at their highest level since 2007. So you can see that here. That's been that downward trend you're seeing there. A lot of course, people worried about essentially the narrow breadth we've seen in the S&P 500. A lot of tech stocks have driven that up. Basically, 7 stocks are what people have been following, such as NVIDIA, driving that run up that we've seen in the S&P 500. Morgan Stanley out with a note yesterday saying that they believe that maybe lagging policy, those impacts could eventually hurt earnings in the second half of the year. They see earnings declining 16% to end the year. We should note that is largely in the minority of what we've been seeing. We've seen actually several upgrades to S&P 500 targets, which Julie, I know you wrote about this morning in our morning brief. And that's what's interesting when you take a look at another chart from Bespoke. So I want to show you a second chart here that shows what happens when we do enter a bull market. And what's interesting here is you can see it's actually normally choppy in the very beginning, but historically over that next 3 to 6 month period, you see the S&P 500 take off pretty significantly. So this is sort of, if we were to enter this bull market, if we do end up hitting that this week, if we hit it in the next coming weeks, of course we could always fall down and never hit it. But if we were to hit it, it's interesting to see that you see that chop through about the first 30 days there, and then historically, on average, it does take off. One other thing that I found interesting from this Bespoke note, guys, was this is the longest it has taken for us to enter a bull market since about the 1950s, the late 1950s. It's been 162 days we've been sort of on this slow track up, and that's historically pretty slow compared to what we've seen.
Yes, this is old in bear market terms, I guess.
Yeah.
Thanks, Josh. Appreciate it. Well, as investors continue to digest May's jobs number and move on to the much anticipated Fed decision next week, our next guest says while the Fed could skip a hike in June, another rate hike cannot be ruled out. Michael Gapen is Bank of America chief economist. He's joining us now. Michael, thanks for being here. Whether you take the jobs report or what have you, I guess what's surprising is the tenor and the discussion around the economic data seems to have improved. But as we were just pointing out, the market is not quite there on re-entering a bull market. Do you think we have a perception gap right now between the actual data and how it's been perceived?
No, I don't think so. I think you're exactly right in terms of the tenor of the discussion around the macro data has improved. That's in part because risks have been reduced. We've gotten past the debt limit. It looks like the bank stress situation is in stasis. It's not getting a lot better, but it's not getting materially worse. And underneath that, the employment and other spending data show an economy that's generally resilient. But I think if you're discussing and debating whether equities are on the edge of a bull market, I think that generally means equity prices are reflecting that broader macro backdrop. I don't think there's much of a disconnect, in my opinion.
We've been following all of the moves of the CME FedWatch tool in whether or not there will be a rate hike or not at the next meeting. Is the data suggesting, from your perspective, that there needs to be one solid decision or another from the Fed?
I think that the decision, I mean, it's tough for them right now because they have said, hey, we've done a lot fast by historical perspectives. And what we'd like to do is take the opportunity to look around a bit and assess those lags and assess bank stress and see where the economy's going and make a decision if we need to do more. It's pretty clear they're starting to lean in that direction. As I mentioned, risks receding a bit, bank stress stabilizing, the macro data generally looking good. They've been communicating that, hey, maybe we do have a little more work in front of us. So the trick will be how do you balance that message next week? Have you seen enough to tell markets you're ready to do more, but just not in June? It's a tricky message to deliver.
Yeah, and as we know, sometimes it's tough with that kind of nuance for the Fed, for anyone, but for the Federal Reserve, where there is so much attention on them. The backdrop for this, of course, is economic growth, whether we're going to enter a recession this year. Where are you on that calculus right now, Michael?
I mean, we're still in the mild recession camp later this year, but about as strong as we've ever been on that is to say we think it's just more likely than not. We've never really firmly pounded the table on that other than to say, look, we think some correction of imbalances in the labor markets ultimately will be needed to bring inflation down to 2%. And normally that does look like an NBER-defined recession at some point. But we've been, at the same time, we have to acknowledge where the data flow is, and that's always been in the direction of resilience. You can't rule out a soft landing, but yes, we think more likely than not, we will have that correction in the labor market later this year.
And so the labor market usually kind of the last to realize that we're in a recession. So does that mean that we'll be in a mild, from your perspective, or a more severe type of recession experienced?
I think mild. And I define mild as something less severe than the average recession. So, for example, a peak to trough decline in GDP in the closer to 1.5% would be where the average downturn has been. I think our peak to trough decline rounds up to 1%. So we're maybe half as severe as the average recession. And this is in part why using the R word sometimes is a little misleading. There's not a major difference from a macro and markets perspective from a mild recession and a soft landing, and I think that's what financial markets are telling you. So unless bank stress gets worse and a credit crunch is revealed, it's harder to see where that hard landing risk is coming from at present.
There was an interesting note out this morning, Michael, from your peers over at Goldman Sachs, who said because we avoided the debt ceiling situation, they sort of ratcheted down their chances of recession this year. I think they're putting it at 25%. I would like to never discuss the thing again, but I am curious if that changed your models at all.
No, it didn't. I mean, our view was always we would get an agreement at the very last minute, or maybe 1 to 2 to 3 days after the actual X date was reached. So we did feel it would run right up to the very end, but we always had an agreement in our baseline. And I think what we just discussed really as part of the debt limit agreement were the budget caps we would have had to discuss under the budget at the end of September, at the end of the fiscal year. So we just brought that discussion forward. And again, in divided government, about what you're going to get is what we got. So this really for us was really no change in terms of our view on fiscal policy. We felt it would be neutral in terms of contributions to the outlook going forward, and maybe taking a breather on fiscal spending after 3 years of a lot of spending is the right idea.
We've continued to hear another R word, especially from some of your peers at other banks over the course of the earnings season, resilient, and saying that the consumer is healthy and resilient. What type of resiliency are we seeing in the consumer right now in comparison to periods prior to other recessions in the past?
Right, yes, this is, as you know, and has been discussed often over the last few years, this is a very different business cycle, a very different recovery. And there's still a lot of support for the consumer from strong labor markets, from deferred and excess saving, as well as wealth effects. And I don't think household balance sheets probably get enough discussion in this conversation. From trough to peak during COVID, household balance sheets added over $33 trillion in net worth. So more than 1 year's worth of GDP in financial prices as well as home prices. All three of those are still supporting spending. They're supporting spending less than they were in the past, and credit conditions have certainly tightened, and the cost of credit has risen, so that's a headwind. But I still think there's tailwinds there that are showing through and keeping the economy in an expansion phase and leaning the Fed in the direction of thinking it still needs to do more.
Yeah, we're going to continue to watch those loan officer surveys very carefully, Michael. Michael Gapen is Bank of America chief economist. Thanks so much.
Thank you.
Coming up, a crisis in cable. CNN CEO may have lost the support of staff and leadership alike. What's the bigger picture outlook for the network and its parent company? CNN executive Chris Licht reportedly apologized to staffers after an unflattering profile in The Atlantic called his authority into question. Licht saying he'll, quote, fight like hell to win back his staff's trust, but some say the damage is already done. A lot of reporting both outside and inside the organization. Frustrations came to a head when a recent Trump town hall, which Licht was quoted, he wanted the audience to be extra Trumpy, drew condemnation from staff. Licht took the helm as CEO of CNN just 13 months ago. And in his short tenure, the network has weathered declining ratings, layoffs, programming shakeups, and several high-profile departures. Warner Brothers Discovery CEO David Zaslav recently appointed David Levy, a close associate, to a leadership position at the network, fueling speculation of declining trust in Licht's authority. CNN trails in the ratings behind partisan cable favorites MSNBC and Fox News, which still boasts strong viewership despite the sudden departure of audience favorite Tucker Carlson. With more on what this shakeup means for CNN and its parent company, Warner Brothers Discovery, is Eric Deggans. He's NPR TV critic and media analyst, alongside Dave Hager, Edward Jones, senior equity analyst. Thanks to you both very much for being here. Eric, I want to start with you, and kind of, there's all this sort of behind the scenes drama that we in the media industry always have fun covering and talking about, and it's interesting for us because we're in it. What about what's happening on air? Are viewers seeing evidence of this beyond that Trump town hall?
Yeah, I think the biggest evidence, of course, was when Chris Licht first took over. Several people were let go, including Brian Stelter, who was a vocal critic of the conservative-oriented Fox News channel and had written a book taking them on. They canceled the media analysis show Reliable Sources and let him go. They let go John Harwood, another correspondent who was considered a vocal critic of conservatives. So they, right away, they sort of set the idea that they were going to try and reset CNN's image as a more centrist network. And then as time went on, of course, they had to figure out what to do with 9 p.m. Chris Cuomo, the person who'd been the star there, was forced out before Chris Licht took over, and they still really haven't figured out exactly what to do with that 9 p.m. Caitlin Collins is going to take it over now. Chris was known as a wonderkind in the morning. He had redesigned CBS's morning show. He was one of the minds behind Morning Joe on MSNBC. So the thought was that he would redesign CNN's morning show, and that, of course, didn't go well because Don Lemon, the anchor there, said controversial things, wound up being let go. And the show just has never caught fire with viewers. So in addition to all this behind the scenes drama that Chris is having, he's having a real hard time doing what his reputation was, creating compelling programming that viewers might want to see. And he's faced two real problems, which is that viewership for regular cable television is dropping every year anyway. And I think CNN's loyal viewership reacted really negatively to some of the things that he's done in terms of trying to change the channel's image, because they viewed it as limiting criticism of conservatives rather than moving CNN to the political center.
And Dave, is this turmoil anything that would show up within the stock price reaction? Has it shown up within the valuation of Warner Brothers Discovery, the parent company?
Well, I'd say in the short term, I don't think it's having a significant impact on the share price. I think the broader question with Warner Brothers Discovery, the parent company, is getting through the post spinoff and merger, combining Discovery with Warner Media, and getting the cost structure of the business to where it can be a profitable business as a whole. And so management's had a lot of challenges on that front, just doing that integration. And unfortunately, the cost cutting has impacted CNN and a number of the other operations within the company. But I think ultimately, in the shorter term, the market is more focused on how the company does towards hitting its financial targets. But certainly, if challenges at CNN continue, that will definitely have a ratings impact and ultimately a financial impact within CNN.
Dave, how much of a revenue contributor is CNN to the overall operation? I mean, I know, obviously it's a big company, but how important is CNN? And then beyond sort of the just dollars and cents of it, how important is it as a reflection, say, of David Zaslav's management?
Well, the company doesn't break out detailed financials for CNN, but I think suffice it to say within traditional cable TV, news shows and news channels have still been decent ratings draws. Certainly you look, for instance, at Fox, it's does fairly well in terms of primetime ratings for a cable TV channel. So certainly getting CNN back on track and improving viewership, I think could be a positive financially for the company. And I think the strategy of trying to take it back to being more of a neutral news source is an admirable goal. It just seems like so far the execution has not hit on the mark of where it needs to be.
And
Eric, I could weigh in on that a little bit and say that as someone who's covered CNN for a long time, I think one of the quandaries that the company has faced is that its American TV operation is a smaller part of its larger, the larger sprawl of the company than people realize, but it is a major definer of the brand. And I think the one of the biggest challenges that Warner Brothers Discovery faces is that the American TV operation defines CNN's brand across the world. And, it has this news operation that reaches across the world, can be seen in TV sets across the globe, but it is often defined by what the American news channel does. And so it's not necessarily just about the ratings that they get on American TV sets. It's about how that brand is regarded as a journalism arbiter, and also how that brand is regarded when you get outside of the polarized political environment that we have here in the United States. What do news audiences in India and China and Britain think about CNN outside of the haze of the political partisanship that we have here in America? And I think, again, they might look at some of the changes that were made to CNN and say they don't make a lot of sense. Because they don't seem to reflect a larger plan for successfully creating compelling content out of a new direction for CNN. And I think that's Licht's other issue, is that he came to a staff, he criticized the work they had done in the past, but he didn't offer a comprehensive plan for how they were going to do things differently. And as the criticism began to mount over what he was doing, he had a tighter and tighter circle of people close to him that he would talk about his plans with. So a lot of people in the company felt they had no idea what he was planning. They weren't really sure how he was going to reflect his values in actual programming, and they felt like the things they were being asked to do were not succeeding. And so that's a big problem when you're trying to rally the troops for a new direction.
And so, Eric, just to kind of follow on that, it sounds like the troops know, because of Chris Licht's acknowledgement, that he has been a distraction, which he apologized for, but it seems like he was even kind of glossing over why he was the distraction. So if there is a leadership change at CNN, number one, do you expect there to be a leadership change at CNN? And number two, how does that drastically change the culture internally?
Well, it depends. It all depends on why that leadership change happens. I mean, the other thing that comes out through the Atlantic article that has become such a crisis point for Licht is that he was doing what the people who own and control Warner Brothers Discovery wanted him to do. So if you bring in a new person and they do exactly the same thing that Licht did, I'm not sure you're going to get much different results. Also, who in the world of TV news wants that job now? Good luck finding someone who is qualified to take that job. There were even questions about whether Licht was qualified because he had never really run a company as big as CNN before he got the job. Good luck finding someone who's qualified to take the job, who's willing to take it on now, given the level of criticism, the level of attention, and the level of animosity amongst the staff and their skepticism about the leadership at Warner Brothers Discovery. It is going to take someone with superhuman powers of management to come in there and unwind some of the problems that have happened. So I think it's largely up to Licht to try and figure out how to undo this. And with a new COO by his side, he can focus on programming, which is supposed to be what he's good at. And hopefully he will come up with some things some wins in terms of new programming that will sort of restore his confidence amongst the staff at CNN.
Well, there's maybe somebody who could do that job. It's the guy who had it before, and it sounds like maybe he kind of wants it back. I'm talking about Jeff Zucker. And in another story that of the many that has been following this whole situation, the idea was floated that maybe he's talked one time or another about trying to buy the network from Warner Brothers Discovery, although it doesn't seem to be in current talks or anything like that. But Dave, just quickly for you, would that be good for Warner Brothers Discovery? Would shareholders actually want it to offload the network entirely?
Well, it could be depending on the financial situation of the network, as you know, it's struggled with ratings recently. That could potentially be well received. It would help remove another source of costs in the business, and certainly CEO David Zaslav has been focused on improving the cost structure and positioning the company for the transition to streaming. And because certainly that's the direction the industry is going. And they really have not set a streaming strategy for CNN. They cut off CNN Plus, which was a streaming strategy under the prior management, because the cost was too high. And so it might make sense, if there was an interested buyer on the right terms, that might be received well by investors, if it could improve the overall financial results of the company.
Interesting. Eric Deggans, who is NPR TV critic, media analyst, and Dave Hager, who is the Edward Jones Senior Equity Analyst. Thanks so much, gentlemen, for taking the time here with and discussing this story that continues to evolve here in front of our eyes. Appreciate it. Coming up, a new report from the World Bank projects global growth slowing this year, but how long do we go? An important interview on the other side. You don't want to miss it. A new report from the World Bank is projecting that the global growth will slow this year, matching the lows of the 2008 financial crisis. We're going live to Washington, D.C., where Yahoo Finance's Jennifer Schonberger has more to share on this. Jennifer?
Good morning, Brad. And for more on the World Bank's latest global economic outlook, I want to bring into the program Ian Kosa, Deputy Chief Economist of the World Bank, who co-authored this report. Ian, it's great to have you on the program. Thanks so much for being here.
Thank you.
You're now projecting that global growth will expand just 2.1% this year. That's down from just over 3% last year, and the same level seen during the 2008 financial crisis. Is the global economy essentially poised for recession territory here?
Jennifer, we don't see a recession this year and next year in the global economy. But as you mentioned, growth remains weak, and there is this unfortunate parallel with the 2008 growth number. The big story is the following. Global growth rebounded significantly in 2021, slowed down in 2022, and that slowdown continues this year. In fact, from 2022 to 2023, 70% of countries will see weaker growth. And that is troubling, to say the least.
You say in the report there's the possibility for more widespread tremors from the banking turmoil that was seen earlier this year, and thus credit tightening, which could push global growth even lower than the 2% level projected right now. Does the World Bank not believe that the banking issues are contained at this point?
I think the initial banking stress has been largely contained in the way policymakers acted aggressively and comprehensively. But when you look at credit surveys, when you look at the latest credit numbers, you definitely see that credit has been tightening and financial conditions are getting more and more difficult. And from the perspective of emerging market developing economies, especially those with larger vulnerabilities in terms of their deficits and debt levels, this is not good news. Yes, in a nutshell, if banking stress gets intensified, we might end up seeing even weaker growth next year.
You mentioned emerging markets, certainly higher interest rates in many of the advanced economies, stresses in the global banking system that we just talked about are spilling over, have the potential to spill over into emerging markets, and particularly be troublesome for those countries that are having to service larger debt loads denominated in US dollars. What is the prospect for an emerging market crisis, something on perhaps the level seen during the Asian financial crisis in 1997?
We do not see a systemic emerging market debt crisis in horizon unless these financial conditions really get tighter and we end up with a credit crunch in advanced economies. The big challenge in emerging developing economies centered around frontier markets, and you see some frontier markets having difficulties, and low-income countries. The big picture is that prior to the pandemic, this 2 decades, from 2000 to 2019, we had around 19 default episodes. Since 2020, we experienced 15 sovereign defaults. Obviously, we are facing debt distress in frontier markets, and half of low-income countries are in debt distress or high likelihood of falling into debt distress. When you have weak growth, when you have high interest rates, it is becoming more difficult to, of course, service the debt, and in some cases, you end up unable to paying the debt. Is this a systemic crisis? No. Is it a big problem, especially for frontier markets and low-income countries? Yes, no question about that.
And is that really why, even absent a crisis, why you see significantly lower growth in the second half of this year? And if you look at that growth number and you break out the different parts of it, you see emerging markets growing at just 4%, below the 6% level that they grew in 2008. Versus advanced economies, which are also going to be seeing slower growth, but perhaps not as slow as what was seen during the 2008 era. What's really driving all of this?
There are 3 important reasons. The first reason is that you have high interest rates. We are experiencing the steepest and fastest monetary policy tightening cycle at the global level over the past 40 years. The second reason is that inflation, as much as it is coming down, it is still high. So it is having an impact on the demand side. And the third reason, which we have already discussed, recent banking stress translated into tighter credit conditions. And that's already having an impact on activity. And when you think about most emerging market developing economies, including advanced economies that rely on trade, trade has been slowing very sharply around the world. When you put all of these together, you end up with this slowdown that has been underway during the past 2 years.
You see in the report that inflation is expected to remain higher for longer. What is your outlook for inflation in the second half of this year, especially taking into account those new OPEC oil cuts that we saw announced yesterday? And how do you think that bodes for Fed monetary policy? Should they be hitting the pause button here in June, or are more rate hikes required to bring inflation down?
So in the context of inflation, there are some good news, and there are some, I think, worrying signs still there. The good news is that in many countries, inflation has peaked, and global inflation has been coming down. Our projections suggest that will continue this year and the next year. But still, by the end of next year, we will have inflation at the global level above 3%, implying that in many countries, inflation is going to be above central bank target rates. That means central banks are going to be on the defensive. So when you think about core inflation, there are worrying signs there. Core inflation appears to be quite persistent, is picking up actually in some advanced economies. And unless we see a sustained decline in core inflation, we do not expect central banks to change their monetary policy stance. With respect to OPEC recent cuts, in the big scheme of the slowdown we are seeing, it's difficult to imagine that will have a material impact on oil price. Our oil price forecast is around $80 this year and the next year. So we see the oil price is range bound on the upside, given this dominant slowdown at the global level.
Ian, we'll have to leave the conversation there. Thank you so much for your insight. So appreciate it. Hope to speak with you again soon.
Thank you, Jennifer.
And that's Ian Kosa, Deputy Chief Economist of the World Bank. Julie, back
Jennifer
to you.
Schonberger, thank you very much. Appreciate it. Coming up, is there such a thing as a risk-free investment? Our next guest says when it comes to what banks are buying, not anymore. We're going to tell you what that is next. Like much of Wall Street jargon, market melt-up is something fancy that describes something pretty simple. This little bit here is what some market participants are referring to as a melt-up, the most recent leg of the rally.
What does a melt-up mean? You see, the market is discounting all these bearish headlines that we're talking about recently, and it still manages to exhibit some bullish price action. So not anything huge, but just kind of melting up.
It's just a Wall Street slang, essentially, for a market that won't go down. And it basically kind of pulls in skeptical investors. So imagine something sort of melting and it spreads as it keeps going. And that's what we're seeing.
After the high-profile collapse of SVB, Signature Bank, and First Republic, the stability of the U.S. banking system is still very much in question. The Wall Street Journal this week reported that large lenders in the U.S. may face a 20% increase in capital requirements in the aftermath. Risk weighting is one way that regulators keep tabs on the system, but in a recent piece, our next guest said there are no riskless assets anymore, and maybe there never were. Joining us now is John Heltman, American Banker's Washington Bureau Chief. And John, of course, my brain immediately goes to treasuries, right, which are sort of the classic riskless asset, but in fact turned out not to be riskless in a rising rate environment. So how should we as investors and media who covers it, how should regulators think about what's on bank balance sheets now?
Just to thank you for the question, and just to kind of like set the table for what we're talking about here. Bank capital is complex, right? So it's not just it's sort of reflected as like you need to have X capital meet that in your good, which is kind of how it works. But there's lots of different ways of slicing and dicing capital. One of the sort of advents of the several recessions ago or several bank crises ago was the Basel Committee, and they introduced this concept of risk weighting assets. And that is sort of acknowledging that some assets are riskier than others, right? So if you are doing a strip mall in Cincinnati that has one kind of risk profile versus a mortgage versus a treasury security, right? And the idea is that you need to hold less capital, or the capital you hold is commensurate with the risk of the underlying asset. But these that sort of risk profile metric has a pretty bad track record. And so to answer your question, like, treasuries were the safe asset this time. If you go back about 10 years, it was sovereign debt. If you recall, in Europe, the sovereign debt crisis around 2011, mortgage-backed securities were seen as very riskless leading up to 2008. So my point with the piece was just that maybe we shouldn't assign zero risk weights to anything, because those things tend to get loaded up in the system and then tend to go boom.
So what does this mean for the broader environment in financial conditions right now?
I think that if policymakers were to take me up on my offer, well, the net effect would be higher capital requirements at banks, because right now there are things that they don't really have to retain capital against. Treasury is a good example. I mean, the most liquid thing in the world is cash, or supposed to be. But then again, we just got past a debt ceiling crisis that would have deeply affected the value of cash. So, like, as I said, nothing is really riskless.
If regulators sort of change capital requirements, or at least broaden the banks that would have to abide by certain capital requirements, does that then sort of take care of the how risky are the assets kind of situation?
Well, I mean, not really. Like, yes and no. I think there's still a place for risk weighting to exist. It is still true that there are things that have higher risks relative to other things. And it is right for regulators to assign higher capital requirements for those things. And if you're a bank, you can decide for yourself how much risk appetite you have. And risk equals growth. So, like, if you don't take any risks, then you don't have any growth. So each bank can decide for itself, to some extent, within reason, how much risk it wants to assume. But I think that the idea that there are some things that are just safe, it has a pretty bad track record. And those things, when things are considered safe and you don't have to hold capital against them, then it makes sense for you to hold more of those things. And when everyone's holding the same thing, those values can go up. And when that value exceeds the underlying kind of secular value of an asset, as we saw with treasuries, banks got a bunch of deposits, needed something to do with it, and they put it in something safe, which is long-dated treasuries. The interest rate environment changed, and they found themselves underwater. So yeah, that's kind of the gist of the point there.
American Bankers Washington Bureau Chief John Heltman. John, always a pleasure to get some of your insights and perspective around the industry. Thanks so much for breaking this down for us.
Thank you.
Switching gears here, we got to talk C3 AI. It's ridden the hype around AI this year, with shares up over 200% year to date. But not everyone is on board. The AI company was the target of short seller Spruce Point Capital, highlighting potential concerns. Yahoo Finance's Ali Garfinkel spoke with Spruce Point Capital's management founder yesterday, and she joins us now. Hey, Ali.
Hi, Brad. So the job of a short seller, of course, is to question a stock. And I want to be careful here accordingly. However, I think it's important to give voice to some of short seller Ben Axler's concerns here, especially given that C3 AI's stock is up a staggering 230% as of the moment I sat down in this chair. The center of Axler's criticism really revolves around the idea of exaggeration. The idea that CEO Tom Siebel is exaggerating the company's revenue opportunities, partnerships, customer base. I asked Axler with Shauna Smith yesterday how far this goes. Here's what he had to say.
I'm not making allegations of that. That's beyond my means. But I am certainly making the claim that I believe there's a lot of puffery going on here. I think there's a lot of exaggeration about, again, the TAM, the addressable market, about how much money's been invested, and ultimately about the prospects for the business.
And Ben, I also want to ask, if we're not alleging fraud, then what do you want to see? What is your message to Tom Siebel?
I think the message is get the customer straight, okay? I mean, we've now seen multiple revisions about what they claim to be the customers.
So I tested this out this weekend. I didn't take Ben Axler at his word, and I spent a weekend with some 8Ks. And what I sort of found was that though C3 AI is very candid about who some of its most high-profile customers are, in a lot of cases, there's some linguistic gymnastics sort of surrounding how many customers there really are. Some examples from these filings, things like customer count is up year over year, or we closed 126 agreements, both of which are a little slippery. And I get that they're trying to show growth, and I really do think that there still could be more transparency. I was hoping to discuss this with C3 AI CEO Tom Siebel today on this show. He was scheduled to be here, but he canceled yesterday. I certainly am hoping for a reschedule, Brad.
As am I. We've talked to him before, so we'll see if we can get it organized once again. Thanks a lot, Allie. Appreciate it. Coming up, Rochelle Akufo has you for the next hour of trading. Stay tuned for a conversation with the CEO of JM Smucker. You're going to be back too, aren't you?
Yeah, CEO of Sprinklr. We've got that locked and loaded, ready to go.
Have a great day, everybody.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. The gradual market melt-up continues this morning. This despite a lukewarm response from Apple investors after its big launch. Wall Street's top strategists are trying to make sense of all the moves. We break it all down for you coming up this hour. And Morgan Stanley warning a sharp profit dip could derail the S&P 500 from its highs. This after Citi said you shouldn't lose sight of a potential pain trade from AI. Our financial advisor will help you look past the noise and position your portfolio. And the SEC is suing Coinbase, alleging the crypto exchange operator evaded regulations by trading unregistered securities. This a day after it took legal action against rival Binance and its CEO CZ. Is this a war on crypto? We'll discuss. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Picking up the pace here, were within the red for most of the morning, but now turned positive. The Dow there up about 50 points on the day. The S&P 500 there also buoyed by about 0.25%. Similar situation, up by about 0.25% as well. The Nasdaq, well, that's around 34 points. Let's also check in on the action we're seeing in the Treasury market as well. Some of that uncertainty seeming to weigh off, seeing people willing to take a bit more risk here. The 5-year up about 0.8%, the 10-year also up about 0.6%, and the longest term 30-year yield there up just barely there, 0.15%. Well, AI hype has driven tech stocks higher so far this year, with Nvidia, of course, leading the way, up over 100% year to date. And Citi analysts say this boom could continue. Here to break this down for us is our very own Jared Blikre. So, Jared, before we get to tech, let us know what's happening in the crypto market, of course, following all of the news this morning.
I'm glad you asked, because I do have our crypto heat map up here. Coinbase got served, and you can see Bitcoin down about 3%. The SEC going after them, saying that they were selling unregistered securities, I believe acting as an unregistered broker-dealer. This comes only a day after a very similar suit filed against CZ and Binance, at least Binance US here. Here is a chart of the year-to-date of Bitcoin, and we can see a little bit of a downdraft here yesterday, but I think what stands out here, we're still in the upper about 1/3 of its trading range for the year. This is still an intermediate uptrend that we're looking at, but now with the series of lower highs and lower lows, we are now in a short-term downtrend. So 25,000, or roughly speaking, is a big approximate level that we're looking at there. What's the fallout in crypto from this? I think, Coinbase has said that if the SEC had its way regulating everything the way they said they were going to, in theory, it'd be very difficult for them to be in business. So this is a life or death struggle here. The SEC has gone to war against crypto. I think a lot of the bad news is already out, but I will say if Binance were to fall in some way, shape, or form, that's probably just too big for the market to absorb. And I would expect that to be a big liquidity taking away event. That's about all I have on the crypto front right here. I'll just take a quick look at some of the crypto stocks. Coinbase itself, not surprisingly, down about 13.6%, Rochelle.
And some of this bullishness on Citi that we talked about here, what are you watching there?
Well, I'll tell you what, you mentioned that Citi note. Their big theme is really concentration risk, and that's something that we've been talking a lot about. Here's what's going on in the market today. We have the Nasdaq up 28 basis points, not a lot. Dow up about half of that. But really the story has been the mega caps this year, and the concentration risk is real. Whether you consider the top 7 or top 8 in the Nasdaq 100, the Magnificent 7 or the something 8, these guys are really driving all the action here. You take a look at what's happened over the last month, some incredible statistics here, but the big question on everybody's minds, can this continue and for how long? We've seen concentration risk survive for over a year, maybe a year and a half in 1999 to 2000 in the tech bubble. These things can be irrational, but they can also be irrational for longer than you and I can stay solvent. Important to remember. So these things have momentum. Sometimes they just feed on themselves. I'm going to do a quick technical analysis on Apple because I think it's still relevant to what we're dealing with right here. Apple is overextended, and it just barely managed to poke above its all-time high yesterday and pulled back down. Apple is a bellwether stock. This tells me maybe it wants to pause. But on the flip side, if it just gets going again, if it just takes off, guess what? These other guys, these other mega caps, probably going to go along with it, and so will the Nasdaq. And there's your pain trade up.
Well, there you have it. Jared Blikre there with that great breakdown there for us. Thank you so much. Well, joining us now with some tips to set your portfolio up for success is Adam Phillips, EP Wealth Advisors Managing Director of Portfolio Strategy. Thank you for joining me this morning. So, I mean, we're seeing how equities have been faring so far this year. A lot of people wondering, though, what are the red flags we should be looking for when you do have this concentration trade among these mega caps?
I think that's a great question. We're talking about the fact that breadth in the market is so weak right now. You look at the S&P 500 up about a little more than 11% this year, up now about 20% off of the October low. And so that's what we're talking about with our clients, and the fact that breadth is low. And really, we're not buying into this just yet. We may be on the cusp of a new bull market here, but I think this bull market really deserves an asterisk until we see some broader participation. And right now, we're just not seeing it. And so what we're telling our clients is to just remain positioned for some additional volatility and downside volatility from here.
So then, as you look at the broader equities market, then what are you honing in on?
Sure. Well, we're looking at some of those players outside of the technology space. Obviously, AI has really driven a lot of the strength there with those large mega cap companies, but we want to see broader participation outside of that. Right now, we are defensively positioned across our portfolios, so we still have an overweight allocation to the energy sector. It's an area that we feel has been rather unloved for a while. It was a source of outperformance last year and has taken a bit of a breather this year. And we still think that there's some opportunity there, also focused on healthcare. But I'd say the theme across our portfolios is really one of defense. And what we're waiting on, I would say, before getting a little bit more optimistic or bullish in our outlook is just some additional signs of strength in the market. Broader market participation, more stocks trading above their 200-day moving averages. And so until we see that, I think we're going to maintain more of a cautious view.
And it can be hard not to buy into a lot of this hype. I mean, pretty much on almost every earnings call, you heard AI mentioned, even if you didn't really get the details of how we'd actually see the use cases for some of this technology. And you expect earnings to actually be revised down in the upcoming quarter. How should people be positioning their portfolios so that they can try and take advantage of some of these AI companies that do have some legs and some of the ones that they should perhaps be more cautious on?
Well, when you talk about AI, I think it's so interesting because, this is a theme that is going to take years to play out. We won't know for quite some time whether it really is as revolutionary as many are hoping. And so I think it means it's going to be tough to pick a winner. I think if people want to play that theme, you want to focus on diversification as opposed to choosing that one winning horse. Within our portfolios, we are we do have exposure to some of those larger names that are often discussed, some of those that have been more of the high-flying names. But, I'd say that right now we are mindful that some of these companies we've seen their valuations really explode here. And so, as far as being a good entry point, we'd be a little bit more cautious here. That's why we're not adding to it. What we are more focused on within our portfolios is diversification. So with our clients, we're really just preaching about diversification. It's so easy to become enamored with today's leading story, which is really AI. And I think many would look to the recent winners and look at, you look at a company like NVIDIA recently joined the $1 trillion market cap club. I think, many will worry that they're missing out on something. And so what we're trying to educate our clients about is that history has proven time and time again that it's about diversifying your portfolio. It's okay to have some exposure to some of those names that may be the beneficiaries of that theme, but don't forget about the rest of the market because that really is just a small subset of the broader market.
And what do you see as some of the biggest risks to the S&P in the back half of the year? I mean, we talked about the pain trade potentially of AI if you get, overly excited about something that may not pan out. But you also have the ECB and the Reserve Bank of Australia also saying, look, we might have some more rate hikes ahead as well, and maybe gauging what the US Fed might do.
I think the Fed is still incredibly important. We're focused on a number of topics. Now that we have the debt ceiling behind us, I think it's just back to the basics that we've been living with for some time now, and that's the Fed and the inflationary outlook. We are going to be watching China and U.S. relations very, very closely. Next week we have the FOMC meeting, the June meeting, and we believe that the Fed is likely to pause. I think what we're going to be interested in is whether they signal a pause or I guess what we would call a skip, whether they're going to provide language implying that this is not a pause in which the next move would be a cut in rates, but whether they're actually going to just take this meeting off, wait for some more information before proceeding with possibly additional rate hikes in the July meeting. And so I think there's a lot for us to remain focused on. One of the things that you did bring up that we're watching very, very closely is the earnings outlook. So far, it's holding up. I'd say earnings have proven more resilient than we would have expected, but we still believe that they projections are likely to move lower as time goes on here, and analysts and corporations start to I'd say realize some of the pressures that they're up against.
Especially if we do get that skip versus a pause. Thank you for bringing that up. Interesting context there. Big thank you there. Adam Phillips, EP Wealth Advisors, Managing Director of Portfolio Strategy. Thank you for your time this morning. All right, taking a look at Shopify stock popping today on news that the sale of its logistics business to Flexport has been completed. As part of the sale, Shopify gets stock representing 13% equity interest in Flexport, which adds to the partnership the two companies created when Spotify invested in Flexport's Series E round in February of 2022. Now, Shopify stock has been booming year to date, up almost 80%, just above 80%, as the company has cut jobs and focused on its main quest of providing e-commerce software to businesses. So enjoying some growth there today. Right, coming up, why hopeful homeowners are facing bigger hurdles for pricier homes. Plus, what the world's changing climate means for the US real estate landscape. That's coming up next. Lenders are losing their appetite for originating mortgages on pricier homes. Let's bring in Yahoo Finance's Danny Romero to give us a temperature check on the mortgage market. So, Danny, for our viewers, explain what a jumbo loan is and how this all ties in.
So a jumbo loan is a loan that is too large to be backed by the government. It also varies depending on the state. But the story here is that the tables have turned. Given the recent banking fiasco, with interest rate volatility, banks are shying away. Investors are dealing with risks as these loans are less likely going to be paid off anytime soon. The other side of the coin, though, for borrowers, there are fewer options. So this could be a positive for borrowers. They can negotiate better terms. But again, if we take a look at the 30-year fixed rate with jumbo loan balances of above $726,000, rates sit around 6.78% for the last week of May. And if we compare that to the conforming loan for the 30-year fixed rate, it's around 6.9%. So that spread is a little bit narrower now. And so this leads to some experts really concerned about liquidity. Some lenders are also artificially pricing these loans to be worse so that they kill the appetite and not a lot, there's not a lot of demand for it as well, weaken that demand there. But again, jumbo loans generally sit on the bank's balance sheet since they're not backed by the government, and they also have higher fees. So the end result, the conclusion here, Rochelle, is that it's going to be a tough market for both the lender and the borrower.
It's going to be a tough time indeed as people try and navigate this space. Thank you for breaking that down for us, our very own Danny Romero. Well, scientists warn that extreme weather events, wildfires, floods and storms are expected to worsen as a result of climate change. Those types of natural disasters threaten cities across the US and could take a toll on their economic prosperity. Recently, insurance industry giants Allstate and State Farm announced they will no longer issue new policies in California, saying that increasing wildfire risks make the nation's most populous state too expensive to cover. Joining me now is David Calloway, Climate Insights founder and editor-in-chief. Thank you for joining me this morning. So I first want to start with this uninsurable trend that we're seeing in places like California here. What does that signal if you're a homeowner or you're a business and you're trying to decide where you'd like your business to be when you see some of these things now becoming uninsurable?
Well, good morning, Rochelle. And it certainly makes the markets tougher. This is a trend. Last week was a big week and really a watershed moment in climate finance, because it's the time when kind of obscure concerns about what climate change might do in the future to us come right home and hit everyone who owns a home or is thinking about owning a home. State Farm is the largest insurer in California, Allstate number 4, I believe. And for them to pull out of new home loans really creates a difficult time in the market. State law doesn't require you to have insurance on your homes, but most mortgage covenants do. So people are going to be scrambling to get insurance. This is climate change coming down to the personal level to affect you and affect me. And it's going to, it'll make it harder. There are backups in California. California has what they call a FAIR plan for insurance of last resort, which is administered by the state. It's about 4 times as expensive as your regular insurance plan. So you can't overstate how important those 2 announcements were. They've been moving towards it for a while. Those people, neighbors of ours who live in the mountains and stuff, were finding their homes were uninsurable. But now to say across the whole state, that's big. We're seeing it in Florida. We're seeing it in Louisiana. All coastal states may see it with rising seas, even New York City at some point. And so the crunch is beginning in the finance from climate change.
And you mentioned the 3 states where we tend to see this. I mean, California, Florida, Louisiana, which are usually the states that you think of when you think of the biggest exposures to climate risk, whether it's wildfires, hurricanes or flooding. But in terms of where you're also seeing the biggest drops in home values in these coastal cities from these climate effects, what are the standouts?
Well, absolutely. I mean, some places like in the Florida Keys and in various parts of the Bay Area here that are right on the beach, homeowners have been told essentially by their towns and their counties, look, we're not going to be able to support you by building seawalls and, building out stilts for your homes and stuff. Essentially, you're going to have to move at some point. And so that, the great climate migration we've been fearing for a long time is something we're going to start to see here. So that affects homes as well. It's crazy though, Rochelle. People are still coming out here. They're still looking for homes on the beach. Phoenix, which has a severe water shortage and heat above 100 degrees, 100 days, it's a summer. It's still seeing record numbers of inflows from retirees and people looking for sun. So, I'm not sure anyone's getting the message, but these types of things with insurance companies and mortgages and home loaners, this starts to spread the message. Next step, obviously, is that it's going to have an economic impact on the cities and counties and states. That's going to affect their municipal bonds. That's going to affect their borrowing. That's going to hit home in all the markets and ripple through the bond markets right into the stock market.
So then when people are trying to look for more climate resilient cities, obviously those are going to start looking a lot more attractive. Where are you seeing some of this climate migration starting to go?
Well, that's a great question, Michelle. Years ago, I was the editor of USA Today, and I asked the staff, pretty much the whole staff, I said, I want to do a story or a series of stories on what climate change looks like in every part of the country. And I want us to find out where the safest part of the country is. Florida has its hurricanes, California, wildfires and earthquakes, freezing cold in the north, devastating heat in the south. Where's the safest place? Tornadoes in Tornado Alley. And they determined, this was about 10 years ago, that it was Salt Lake City, Utah. No problems with earthquakes, hurricanes, wildfires, and tornadoes. What we didn't realize a decade ago was that the Great Salt Lake is drying up and may not even exist in 4 or 5 years. So even Salt Lake gets hit. A lot of people now are talking, you see, it's fashionable to talk about Duluth, Minnesota. With all apologies to my relatives in Minnesota and Wisconsin, Duluth is no person's place of somewhere you want to live. It's very cold in the winter. But they're saying it's going to be a perfect paradise in 20 years with climate change because the winters will be warmer, the summers will be cooler, and there'll be no devastating wildfires or hurricanes. So I think you're going to see more stories like this, trying to find the Duluths of the world, not just in the U.S., but everywhere. As you start to see a migration, we're not seeing it yet because the economy's still fairly good historically, and climate change hasn't had that much of an impact yet. But when we start to see these insurance moves, this means the financial markets are paying attention to it, and it's beginning.
Now, of course, when we think of environmental investing, you think of ESG investing as well. But when you think of a state like Florida, when you have Governor DeSantis, who could potentially end up being president of the United States, what do you think the future holds then for ESG investing, and what that perhaps turning point will be for it to be taken more seriously?
Well, DeSantis's move against ESG is really a head shaker. I mean, obviously, it's a political move. He's taking advantage of the kind of anti-woke culture wars that we're seeing playing out across the country to put ESG in there because Florida is on one of the front lines of climate change. DeSantis's record actually on environmental stuff is not that bad. He's done a lot to protect Florida's resiliency. But when it comes to kind of talking about ESG and national attempts by essentially state pension funds like the Florida Pension Fund or Texas Pension Fund to hedge against the risk of climate change on their properties and on their investments in their states for their retirees, attacking that is really just shooting yourself in the foot. Of course, the danger is if this goes national, it could become a national crisis. I mean, the GOP is already suing in federal court to overturn a Biden law, which was brought in to essentially offset a Trump law that said you can't regard environmental risks when investing. So the GOP is going after this on a federal level already. DeSantis is going to use it as a club in his election campaign. And Trump really, kind of laughed off climate change. He joked about it. DeSantis is really putting himself in the position of climate denier in chief, and he's going to make it an issue in his campaign. Whether it actually, resolutes with anybody, I don't know, but it's certainly affecting how Wall Street thinks about ESG investing right now.
Certainly worth keeping in mind. Lots of great insights there. Do appreciate you joining me this morning, David Calloway, Calloway Climate Insights founder and editor-in-chief. Thank you so much. All right, coming up, the founder and CEO of Sprinklr joins us to discuss the latest round of earnings and how the company is continuing its growth drive. Don't miss it. Sprinklr shares on the move after its first quarter earnings report, seeing a beat on the top and bottom line. The New York-based software company was founded in 2009 and went public via IPO in 2021. Now, it powers software for customer experience management of large corporations such as Microsoft, L'Oreal, Cisco, and Samsung. Joining us now is founder and CEO Raji Thomas, and also joining us is Yahoo Finance's Brad Smith here for the conversation as well. Big welcome to you both here. So Raji, walk us through the quarter that was, and especially when we see how much of this was driven by this higher subscription revenue.
Well, thank you, Brad. It's great to see you again. The quarter was an excellent one. We had a beat on pretty much every metric. Reported revenues of $173.4 million, which is a year-over-year growth of 20%, and subscription revenues came in higher. Growth percentage was higher at 24%. And I think what was surprising for most on the street was the fact that we also posted $11 million of non-GAAP operating income.
I think what the street was also paying close attention to, and it's great to see you, Raji, really paying attention to this guidance here. And so what are you seeing within the relationship, what you're hearing from some of your customers right now that gives you confidence to come back out to the street and communicate that there's a strong amount of demand that is really going to benefit Sprinklr?
Well, it was cool to connect with, the few hundred customers I was able to connect and talk to in the last several 12 months. What we are hearing consistently from all customers across industries that we serve. Now, keep in mind, these are some of the largest companies in the world. What we're hearing is that what's going on in front office technology, customer-facing technology, is unsustainable. When you think about a large global company, let's take a Microsoft or a Samsung or a Dell or any of the large global companies, you're talking about large businesses that have multiple business units, some case like 40, 50, 60 business units, which are large companies in of itself. Each business unit operates in, 50, sometimes 100 markets. And in each market, they're doing customer service, they're doing marketing, they're doing advertising, they're doing voice of customer surveys and insights and sales. And in marketing in the UK, they're using 5 to 15 channels. And now think about a consumer or a customer of that brand on the other side. It's cacophony. It's impossible for a large company to stay on brand and create consistent brand messaging across all these channels, across all these functions, across all these markets, and across all these business units. And we have stuffed the front office with somewhere between 50 and 75 point solutions on an average, almost in every function. It's unsustainable because they don't talk to each other. You can't see the customer across these systems. So I'll give you the example of a large credit card company whose contact center we just replaced and upgraded with Sprinklr. Before Sprinklr, if you emailed the agent, the email customer service agent was just unable to use any other channel. So if you asked for a credit limit increase on email, he had to wait for the customer to respond back if you asked a question. Now you hit the phone button. Hey, sir, can you provide your supporting evidence for your income? And then boom, the case that would have taken a week now takes 20 minutes to close.
Sounds like, on the productivity front, that's a huge benefit for some of these companies. And on that topic of productivity, what we've continued to hear and track over the course of this earnings season is any mention of artificial intelligence and generative AI. When you think about your own business, I see you smiling, I see you laughing at this one, but at the end of the day, investors also want to know, all right, for a company that has a founder CEO like Raji Thomas, how you're thinking about generative AI with some of the existing Sprinklr framework and where that could potentially benefit some of your customers that are looking for better productivity.
Right, that's a great question coming from you. I'm sure you recall that we had almost 7 pages describing our artificial intelligence in our IPO prospectus. So first off, AI is something that we've been talking about, and our entire platform has been built on for the last 5 years, and it's a core differentiator for Sprinklr. Let me just help everybody understand the way we see AI and what we see happening now. Yes, there's a lot of buzz about generative AI now. There's plenty of companies that are jumping in, introducing product SKUs, and most of them are doing something very simple. They have a developer or a small team making a call to an open AI API and putting the results back, and it looks cool. Let me tell you what the problem is. If you don't control the data set that the AI is trained on, if you're training your AI models on unbound data sets, your results, your outcome is going to be unpredictable. In the enterprise world, we now have countries that are running on Sprinklr. Qatar government cannot afford to have Coca-Cola, Microsoft, McDonald's, JP Morgan Chase, Citibank, they can't afford to have unpredictable outcomes in the front office. It has to be on brand, it has to be compliant. So there's a lot more rigor. You can't afford when bot makes a mistake or ChatGPT makes a mistake. That's fun. It's a joke. But brands can't afford to do that. So what we have done for the last 5 years is we have developed over 2,000 models. actually hundreds of models custom done for customers. And these models have been trained on pretty much all publicly available data in over 100 languages. And we make over 10 billion predictions a day. Every part of Sprinklr is built on AI. And what we are able to do with generative AI now is to take cryptic messages that we're doing in terms of AI-driven generation. I'll give you an example. In the contact center, we had something called a smart response that would allow the agent to suggest a response. And before generative AI, it was just kind of cryptic. We would parse through all the cases in the past and say, hey, suggest this option as a way to fix. With generative AI, we can give them an entire script. So we're seeing 300% increase in adoption of that feature with generative AI. But there are like hundreds and thousands of AI features, and generative AI is giving us wings for our AI capability.
So Raji, in terms of the growth story from here, I mean, I know you opened a new R&D hub in India as well, but on the other hand, you have regulators sort of really trying to figure out how they can put some guardrails around AI. How do you sort of focus on the growth story while keeping an eye on what regulators might have planned as well?
We are very, very, very early in the AI revolution. It's going to be a quantum leap. I think I'm a fan of responsible AI. I think we've seen this in crypto. We've seen this in social. I think we should come up with frameworks very early on and not wait for game-changing technology like AI to grow without control. And then you're going to have a lot of companies go out of business because people get just pumped up and a lot of people lose money. And so I'm a fan of responsible AI. I'm a fan of common sense regulations that allow companies like Sprinklr and Google and Facebook and others who work on AI to put stuff out there responsibly.
Hey, Raji, just while we have you, you mentioned advertising right now, and typically during an economic downturn, advertising is one of the first marketing spends to go. We're going to be at Cannes Lions speaking with a range of chief marketing officers, perhaps some of the clients that you work with as well. And I'm wondering, even as we're thinking about the impending economic downturn that has been widely telegraphed, can advertising do enough to get some of these companies through the other side, or to generate enough demand to get companies through a downturn? And we only have about 30 seconds.
We're spot on. There's a pullback on advertising and marketing spend. People are stepping back to see how it shakes out before spending again. The good news is we have put about 80% of our energy into our contact center product, which is like taking off. And our thesis is that we bring customer service and marketing and sales together so we can transform those agents into salespeople, and then really convert your contact center into a revenue center.
Well, it's been absolutely fantastic having you on and breaking all this down for us. Raji Thomas there, Sprinklr founder and CEO, and our very own Brad Smith. Thank you both.
Thank you both. Talk soon.
All right. Coming up, MasterCard is doubling down on its commitment to financial inclusion. Find out how next.
We got a couple of big announcements here from the tech giant, and among them was this long-awaited headset that we're looking at right now.
We heard Tim Cook say specifically it's the first Apple product you can look through and not at. And we do have a price tag, $34.99. We're talking about $3,500, and that's going to be the real test for Apple. How many people are, willing to shell out that kind of money?
I think a lot of people are going to balk at that price. Apple recognizes that this is going to be a low-selling product for the time being, and then eventually they'll likely lower the cost of that. But as far as VR, AR goes overall, this seems to be the one that's going to get people the most interested.
I think they did a good job of positioning it in a way that a lot of different people could see, oh, maybe I could use that. That is, of course, until the price point hit, and then that's obviously a big concern. The question really for me is, what's the long-term wearability of the device? But that'll be a big question, is what's the long-term comfort, and then does it deliver enough value for that $3,500 price point?
$3,500 is a tough pill to swallow for anybody. It creates a difficult go-to-market, I think, but Apple is very good at delivering unique content in a very seamless way.
There was a bit of a decline coming into the opening remarks here, and then we really saw a big sell-off. That big down red candle, that came off on the announcement of the headset. Is that ominous? I think it's a little bit too early to tell you, but I think it's notable, too, that Apple had climbed to a record high just before that announcement.
MasterCard is doubling down on its commitment to financial inclusion, announcing that it's already reached its 2025 goal of providing 25 million female entrepreneurs with solutions to help grow their businesses. Shamina Singh, MasterCard Center for Inclusive Growth President, joins us now. Great to see you again, Shamina. So
nice to see you,
talk
Rochelle.
about this landmark. Very good to see you. Talk about this landmark that was reached, because this landmark wasn't supposed to hit until 2025.
Well, we're really fortunate that we, like many people, didn't know the pandemic was coming, but we prepared in advance and happened to be in the right place at the right time to ensure that women entrepreneurs, women small business owners received the support they needed to not only open some small businesses, but grow them and get through the pandemic and then come out even stronger than before. So we're really proud of the achievement, but really grateful that we were able to provide those kinds of resources to the amazing women who need them.
And so in terms of the stories that stand out, when you think about the impact, the economic impact that this can make for these women and the broader communities, what sort of stories stand out for you?
Well, it's really, the way I think about it is when you invest in women entrepreneurs, think about it as they pay it back and they pay it forward. They pay it back because their loan repayment rates are over 90% normally for the size and the amount of loans that they are taking. So they're really great risks because they paid the loans back and they pay it forward. What we also know is that when you invest in a woman entrepreneur, she pays it forward to her family, to her community, to all of the things that surround her and her small business. So the impact of investing in a woman entrepreneur is double, triple, quadruple what you get when you invest in a single entrepreneur.
And I want to ask you, because obviously we're in an era of tighter lending conditions, and I know that it's a philanthropic side, but it's also a corporate side and really a partnership here. Have you seen any sort of pullback or perhaps more strategic investments in this space?
Yeah, it's interesting because, and that's why I think it's important to say that it is a combination of commercial and philanthropic activity coming out of MasterCard. Because again, during this time of transition, we have to make sure that we're using every tool and lever at our disposal to ensure that women small business owners and all small business owners come out of this transition period on the other side. And so for the commercial side, we have a whole set of solutions. From the philanthropic side, we have a whole set of enabling solutions. But the point is that as the economic conditions change and as we see loan terms change, we have to make sure we're doing everything we can. And that also means, Rochelle, that we have to think about lending to women sometimes differently. The notions of credit or collateral are different for some women than they are for other borrowers, because sometimes they don't have the same types of assets that their male counterparts have. And so that's another creative way and an innovative way that we're looking at partnering with women entrepreneurs.
And one thing that you focus on is an inclusive digital economy. What does that mean now in 2023, especially when you factor in things like AI and how that's really making sort of a borderless economy when it comes to being inclusive?
Yeah, I mean, Rochelle, in some respects, digitization and digitalization for small business owners, it really has to be table stakes. And so, again, before the pandemic, we saw really good adoption of digital processes. During the pandemic, I think it became quite clear that if you weren't able to digitize, if you weren't able to operate in a way that allowed you to meet your customers, sometimes remotely, to offer remote payments in a safe and secure environment, you were going to have a really tough time surviving the pandemic. And we've seen that knock-on effect even today, that The minimum is digitization of processes and resources, and that's actually one of our the cornerstones of our Strive program globally. We have a Strive Small Business Signature Initiative where we focus on getting capital that we talked about earlier, going digital, which is table stakes now, but really making sure that we adapt to the new technologies and growing your networks and know-how. So we have to think of three parts of the stool to support all small businesses, but look at them intricately and differently to make sure that we're adapting to the needs of women small business owners.
And so when you look at some things like recession fears that are coming up, sort of another potential, shaker for some of these small businesses that perhaps would like to hire but aren't able to find people and would like more funding but perhaps aren't able to get it. How are you preparing them in terms of the resources available that they can use?
Well, I'd love for any small business owner and for any organization who works with small businesses to really make sure that in the United States they're working with CDFIs, and those are community development finance institutions that are mission-led and very close to the small business community in the sense that sometimes they act as a bridge between banks and the small business owner, so that if you are in an environment where you need that extra help, you need the time and attention it takes to get that first loan, the CDFI community, the CDFI space in the United States and the microfinance institution community outside of the United States are really great places to go. I'll just give you an example. In the United States, we work with Gapen America. We also work with the Community Reinvestment Fund. We work with Momentus Capital. When we work with those organizations, and I would encourage you to look at those organizations, they ensure that not only are they providing the training and the wraparound support and services and the accountability, but also access to the capital that the small business owner needs. So especially for women, I would definitely advise you to have a look at Gapen America if you're in the United States and make sure that you connect with the fabulous work that they're doing.
Well, I do appreciate you, especially laying out the resources, because sometimes a lot of people just really don't know where to start and where to find them. Thank you so much, and congratulations on that milestone there. Shamina Singh, MasterCard Center for Inclusive Growth President. Thank you for joining us this morning.
Thank you.
Well, the PGA Tour and Saudi-backed LIV Golf stunned the sports world by agreeing to a merger this morning, putting an end to a chaotic time for the industry that's dominated headlines in the sport for over a year. Yahoo Finance's Josh Schaefer has the details for us. Josh, I did not have this on my bingo card in any way, shape, or form.
I did not either, Rochelle, and it doesn't seem like most of the golf world did either, as I've been looking around the internet today. So what we have is a merger between PGA Tour and LIV Golf, the Saudi-backed LIV Golf League that we have talked about so many times on this program over the last year. And I want to read you a statement from Tour Commissioner Jay Monahan, PGA Tour Commissioner Jay Monahan. He said, after 2 years of disruption and distraction, this is a historic day for the game we all know and love. The transformational partnership recognizes the immeasurable strength of the PGA Tour's history, legacy, and pro-competitive model, and combines it with the DP World Tour and LIV. So the DP World Tour also combined into this deal, Rochelle, but of course we've mainly talked about LIV Golf, backed by the Saudi Public Investment Fund, and the PGA Tour. A key part of this that is still to come is how LIV Golf will be integrated into the PGA Tour, if at all. A memo out to PGA Tour players today obtained by Yahoo Finance said that the LIV Golf schedule is expected to continue as scheduled for 2023. But a big part of this, Rochelle, is that Saudi Public Investment Fund is what is going to be making a big investment into this new entity. The new entity does not have a name, the combined entity of the PGA Tour and LIV Golf, but the Saudi Public Investment Fund will be bankrolling a large portion of that new league. So you can sort of see maybe some of the PGA Tour's maybe media deals and sort of the public side of that has positive reaction, combining with the Saudi PIF money to create sort of this big, giant golf conglomerate. You can see golf stocks today have actually popped on this. Callaway golf stock up about 5% on this news. It seems like the market overall for golf stocks is bullish on this for the industry.
Because I remember when we were first talking about this, we talked about, some of these key golfers who chose, the paycheck and going to LIV Golf. What does this mean then in terms of perhaps some of these paychecks? We know it put some of the litigation to rest, but what about the future of how some of these paychecks might pan out?
Yeah, Rochelle, so those litigations, like you said, have been put to rest, right? So there was lawsuits kind of coming from both sides here. Those are off the table, and it's going to be interesting to see what does happen with the paychecks. Right now, that's currently unclear from my understanding. But a lot of those LIV players were paid money over the last year, significant amounts of money. We heard over $100 million for some players to join that league. And now it seems like they might be welcomed back into the PGA Tour, or at least folded into this new group, which will include everyone. So perhaps maybe some of those players that first joined LIV might just be overall winners from a financial standpoint here, having joined the LIV Tour, received some of those benefits that were traditionally a lot higher than PGA Tour players have been paid. And now a player like Brooks Koepka might be back with some of his former PGA Tour members on a regular basis moving forward.
Well, we'll continue to follow that reaction. Thank you for that update, Josh Schaefer there. It's still wild to me. Yeah. Thanks so much, Josh. All right, well, we're watching shares of JM Smucker after the company saw growth in all three of its business segments, with net sales growing nearly 10% on a boost from price increases. Now, the maker of Jif peanut butter forecast a smaller than expected decline in annual revenue amid strong demand for its ready-to-eat meals. CEO Mark Smucker joins us now alongside Yahoo Finance's Brooke De Palma. Thank you for joining us this morning. Now, we are seeing the stock price under a bit of pressure at the moment here. What do you think they're honing in on, Mark?
Well, I think you're just seeing the entire sector being affected by some of the macroeconomic environments. I think at the end of the day, we're incredibly proud of our results. We've had 13 quarters consecutive of beating expectations, and we're poised for further growth as we just began our new fiscal year. We've executed our strategy exceptionally well, where we've made some divestitures, which have allowed us to focus on our growing brands like Uncrustables, obviously Dunkin', Cafe Bustelo, and notably our Milk-Bone dog biscuits, which are all growing very, very healthily as we move forward into this new fiscal.
Good morning, Mark. Brooke here. Let's break down those Milk-Bone sales. We saw sales grow 20% this quarter. Break down for us who exactly the audience is there, and are you seeing perhaps higher income customers trade into the Milk-Bones brand?
Yeah, sure. Actually, the Milk-Bone brand is a great example of a brand where we play across the entire spectrum of value. So we have our base core mainstream biscuits, which are very affordable, all the way up to our high-end dental chews, long-lasting chews, and then all different versions of our biscuits, which are stacked or dipped in various ways. And so just a very broad portfolio that highlights how we are going to market across our other brands as well, allowing the consumer to access products that they love, brands they love at various price points.
And Meow Mix, the demand there is actually outpaced production. Break down for us how you're exactly addressing this and when we can expect supply to meet that demand.
Well, you know, I'm so proud of our employees because throughout the pandemic, we faced a number of supply chain challenges that we overcame. This is no different. We are seeing demand for Meow Mix very strong. And the demand is actually outpacing supply. So we are right now investing in both infrastructure and labor to ensure that we meet that demand. We would expect to come out of this over the next 6 or so months, or slightly beyond that perhaps, but we are working to make sure that our supply meets demand on Meow Mix. It's just a fantastic brand.
And Mark, something that powers humans, of course, coffee. You've got to talk about the coffee play here, especially with Folgers. Talk about that competitive pricing and how you think that positions you when you think of consumers really trying to tighten their belts, preparing for a recession, perhaps not wanting to spend as much or trading down with other products, say, like a Starbucks.
Sure. We have 3 brands, Folgers, Dunkin', and Bustelo, 3 of the top 8 brands in the category. Folgers is the #1 brand. Again, here we play across the value spectrum, offering products that consumers can't afford. But even our Dunkin' brand, which is the more premium brand, has actually returned to growth this quarter. And so we would expect to see that momentum. Pricing is competitive. We're seeing the pricing in the category more normalized, and that allows us to compete effectively and continue to grow all 3 brands, which are showing solid performance.
And let's make way into that Dunkin' brand debate. You're looking to make a bid for Gen Z here. You're launching a liquid coffee concentrate in July. You're saying that is something that Gen Z really enjoys. Break down for us how exactly you plan to launch this and why exactly you think now is the right time and what sort of response you're hoping to get from this investment.
Totally. So 71% of cups consumed of coffee are consumed at home. And as the leader in coffee, over the years, we have effectively transitioned our portfolio to where the growth is. So you think about K-Cups, premium coffee, there was a shift there. Consumer behavior is now consuming a lot of liquid coffee. They're making customized drinks at home in the morning. This is, millennials and Gen Z are doing a lot of this. And so launching the Dunkin' Concentrate is a perfect way to get into that market. And then later in the year or in the next fiscal year, we'll be launching liquid coffee for Bustelo as well. So both of those brands will be playing in that space, and just another example of us shifting to where the consumer needs is.
And we've been talking a lot over the past year about snacking, about how people just aren't willing to pull back on their snacks. It's like your one precious thing to hold on to. Talk about that consumable market there, and what have been the strongest growth drivers for you?
Well, Uncrustables, as you know, peanut butter and jelly sandwich is the #1 lunch sandwich in America, and that product is a rocket ship. We're building our 3rd manufacturing facility to make more PB&J sandwiches. It meets the consumer need of being portable, on the go, convenient, and no mess. And it actually has no prep other than allowing it to thaw. So it's something that parents love to give their kids. You can see, you were talking about golf previously. The golfers are obviously eating it, and even during the March Madness, we were fortunate enough to have many of the commentators, including Charles Barkley, profess their love for Uncrustables. So it is a universal product that is loved by all Americans.
Mark, really quickly here, we're hearing that sugar inflation has finally caught up. Ingredients cost about 70% of your total goods. What are you seeing as far as inflation impact on your ingredients so far this year?
Yeah, to be honest, it does come back to making sure, first and foremost, that our products are meeting the value needs of our consumers, which they are. We do view that we are still in an inflationary environment. It is nothing like some of the inflationary environments that we had over a decade ago, so we think that it's manageable, and we continue to work to manage our own costs. And as we've passed along some of the price increases, we've done that in a very prudent and thoughtful manner, working with our retail customers to continue to provide value to the end consumer.
Mark Smucker there. Thank you for taking the time to join us this morning. JM Smucker Company's CEO, alongside Yahoo Finance's Brooke DePalma. Thank you so much.
Thank you.
You're very welcome. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.